So good evening, students. A very good evening to all of you.
Good evening, sir.
Good evening, Kanaya, Radha, Yogendra, Charita. Good evening. So, students, in the today's class, we'll proceed the discussion further. Now, students, today we will be looking into students. We will be looking into the first way. In the last session, we have already have considered the provisions which were related to the capital gains computation. We also looked into very special tax rates also which is involved for the capital gains tax. So therefore, for this particular heads of income, we have the special rate of tax. If we can recall the three sections where we found the special rate of tax applicable in computation of a capital gains, that is, one was section 196, second was 197, and third is 198. So far as section 196 is concerned, students, that is in respect of the short-term capital gains on transfer of equity shares in a recognized stock exchange on which STT has been paid. For 198 section, the same particular set of security which is involved in transfer of the securities which are transferred in the recognized stock exchange on which the STT has been paid, but that should be in the nature of long-term capital asset. That should be in the nature of long-term capital asset. And then there is section 197 also. For 197 students, that is a long-term capital gain tax rate other than section 198. And that is applicable in respect of all the assets. 197 is a long-term capital gains tax rate which is applicable to all the assets, students, other than that 198 category. So for all the other long-term capital gains, the tax rate is at 12.5%. That is what we have seen. And one very important particular point in the last lecture that we have discussed was in respect of that land or building where there was an option which was available, an option of indexation. Otherwise, we have seen that the indexation as a concept is now gone. But yes, now we do know that the indexation option is available only in one particular case that we have discussed in the last session. Notably, students, very important point, which is about the fact that the indexation benefit, students, is only applicable in respect of resident, individual and HUF. So in all the other cases, students, in all the other cases, like partnership firm, company, and other particular SSE, other particular persons, this particular option of indexation is not available. And more importantly, students, again, I'm repeating this point. This option is to be made available only in respect of land or building or both. Okay, so therefore, just keep this particular important point in mind. However, I told you that in the computation of your total income, in the last lecture, I told you, students, that in the computation of total income, you will not be doing the indexed long-term capital gains for this particular case. You will compute the long-term capital gains without indexation. But when it comes to the calculation of tax liability, at that particular point of time, you are supposed to see the two options. And whichever is more beneficial, you are going to take up that. What are the two options? Option number one, without indexation at 12.5%, with indexation at 20%. Whichever is more beneficial, you are going to take up that particular option. Is that point clear to all of you students? So this is what, students, we have seen in our last particular session in that particular context. And now we will proceed. By the way, students, I must tell you your fourth module, primarily, which is all about the taxation of non-resident. In that fourth module, students, you are going to find that there are other special rate of tax on the capital gains. Other special rate of tax on the capital gains, mainly it is long-term capital gains only, but exclusively applicable to a non-resident. So right now what we have discussed, that is section 196, 197, 198, is a general special rate of taxes, primarily which is applicable to all the SSE. But when you do that module number 4, there would be some more long-term capital gains tax rate that you're going to learn. and that would be made applicable exclusively in respect of a non-resident SSE. I hope that that particular point is well taken by all of you. Okay, we will see when we come to module number 4, primarily on those particular special rate of tax which is applicable to the non-resident. Fine, students. Now, shall we proceed further? All set? Perfect, students. Let's start, students, now. So, students, now we take across primarily our discussion further. In that, students, you're going to find now in the part B, in this context, the provision which is specific to the real estate, students, over here. Now, I think this particular section you would have done in inter CA level also, primarily, and as such, there is no such particular amendment that is there. The same provisions is also repeated in this new act as well. But nevertheless, it's an important particular provision so far as a real estate transaction is concerned. Students, the entire here is about when you sell a real estate, what shall be the full value of consideration that will be adopted? What shall be the full value of consideration that will be adopted? Now, friends, I will be asking you one very important question immediately after this discussion is over, and I'll give you a brief note on something which I want all of you to always remember that point. Okay? But before that, let's finish it off this section first. So, students, as you would know, that in a real estate transaction, there is a case for where whatever is the consideration amount that you have received, that consideration amount is compared with the stamp duty valuation. And then we see a kind of the difference. If the stamp duty value is higher as compared to the actual consideration amount, then that difference we check out whether it exceed the tolerable limit of 10% or not. The difference, students, we check whether that exceed the tolerable limit of 10% or not. If it exceeds, if the stamp duty value minus the actual consideration received, if that difference exceed the 10% tolerable difference limit, then we will ignore the actual consideration and we'll go with the stamp duty value. We'll go with what, students? We'll go with the stamp duty value. However, if the difference does not exceed that 10% tolerable limit, then in that situation, we will ignore the stamp duty value and we will proceed to adopt the full value of consideration as the actual consideration amount. As what? As the actual consideration amount. Is that point clear to all of you, students? So this is something which has been there. Here there are a couple of important points that you should be aware of it. We will see this discussion further. So general rule, students, as I've told you, if the consideration for transfer of land or building or both is less than the stamp duty value, so it should be less than, students, then the stamp duty value is deemed to be full value of consideration subject to the tolerance and the agreement date value. We'll see that particular point also, don't worry. 110% tolerance. So that is 10% what I was talking about it. So if the stamp duty value does not exceed the 110% of the actual consideration amount, then it means that the difference is not more than 10% tolerable limit. The difference is not more than that 10% tolerable limit. In such particular case, students, the full value of consideration that we are going to take will be the actual consideration amount. That will be deemed to be the full value of consideration. Okay, now students, in certain cases where the stamp duty value is higher as compared to the actual value, but if the SSC can prove that primarily by making a reference, SSC feels that, not proves, SSC feels that though the stamp duty value is higher as compared to the actual consideration, but that stamp duty value is not more than the fair market value. The stamp duty value is not more than the fair market value. Then in that particular case, what will happen? Let's have a look, students. DVO reference condition 1. If the SSC claims that the stamp duty value exceed the fair market value of the property as on the transfer date, so the stamp duty value is much higher. That is what the SSC is claiming, that the stamp duty value is much higher as compared to the fair market value of the property as on the transfer date. Then, students, condition number two. The
Excuse me, sir.
stamp duty value has not been disputed in any of the appeal. Means SSC has not challenged this adoption of stamp duty value in any of the appeal or revision, and no reference has been made before any other authority, court or the High Court. Then students, the accordingly the departmental valuation officer will then take a note of that particular application or the reference. And if, now see the two situations, if the DVO value is lower than the stamp duty value, in that case the DVO also gets convinced that yes, the stamp duty value is higher and the DVO's value is lower than the stamp duty value, then whatever is the value as adopted by the DVO will become the finally the full value of consideration. Okay. However, if the DVO value as per the report is higher as compared to the stamp duty value, then the question that arises, students, is whether in such particular case, sorry students, I've not shared the screen. No? Sorry, just extremely sorry. Yeah, Yogendra, you should have just reminded me.
Sir, nah, that is why what I
Yeah,
am
yeah, yeah,
asking.
yeah, yeah, yeah. Just sorry for this one. I'll just share the screen. I hope that this is visible to all of you now. Okay.
Yes, sir.
Students, can you just read up till this? Just read this particular page. I was just going through it so that just go through it once quickly. Fine, students. So if the DVO value, students, is lower than the stamp duty value, then the full value of consideration in such particular case will become the DVO value. However, if the DVO value is higher as compared to the stamp duty value, in such particular case, then you're not supposed to adopt the DVO value. In such case, the maximum limit for the full value of consideration would be the stamp duty value only. I hope that this particular point is well taken by all of you students. In this case, the simple illustration is actually that you can refer it. I don't, there's no need of me to refer this. The same thing has been referred. It's a simple particular illustration which has been there of this particular context. Now, students, over here, this is an important one. Date of agreement versus date of registration. The question therefore arises is that on which particular date I should be taking the stamp duty value. Should I go with the agreement date or should I go with the date when the property gets finally registered? Primarily. So at the time when the registration happens, and at the time when the registration happens, students, obviously at that time only the stamp duty gets calculated. Means, technically speaking, the stamp duty gets calculated primarily at that particular point of time. When the registration happens, that is a general rule. However, in some other states, primarily earlier, there are two particular conflicts that when finally the property gets registered, maybe in some state it happens towards the end of when the installment has been paid. At that time, the registration takes place when the full installment has been paid. Sometimes on the payment of 20% installment only, primarily the registration has to happen. At that particular point of time, the stamp duty value has to be paid. So it depends. It's a state subject. So therefore, it keeps fluctuation as to on which particular point of time you actually have to pay stamp duty. But more importantly now is that full value of consideration which I'll adopt, if at all, if I have to consider stamp duty value, which stamp duty value should I be considering it? Supposingly, I have to compare the actual consideration with the stamp duty value and then check whether the difference is more than 10% or not. So the question arises is that when I have to compare with the stamp duty value, which stamp duty value should I adopt? Should I adopt the date of agreement stamp duty value or should I adopt the date of registration stamp duty value? That becomes the issue under consideration. So here, students, what they say is that generally it is the registration date. Generally, students, it is a registration date because at the time of registration only, I come to know exactly how much stamp duty I have to pay. So that is a date where they say take up the stamp duty value as on what? As on the date of the as on the date of what, students? As on the date of the registration. However, you are allowed to take, students, you are allowed to take the stamp duty value as on the date of agreement if certain conditions are fulfilled. And what is that condition, students? Is this that there is a requirement where you have to pay the consideration, where you have to pay the consideration before the registration. Before what, students? The registration in this particular context. Or before the agreement. So before the agreement, primarily there is a some consideration that the assessee has to pay. Like say for example 10%, 20% is what I was telling you, isn't it? In some state, in 20% also you would have paid primarily. Then what happens? The agreement happens and then thereafter you go for the registration purpose. In such particular case, students, what they have said, be careful, just have a look over this condition and then this is an important one. So see here the condition. Agreement fixing consideration and registration must be on different date. Obviously, the date when I have entered the agreement to transfer my property versus the date when the registration will take place. Obviously, on that of that property has to be two different dates. That is understood. Condition precedent. Part or whole of the consideration must be received on or before the agreement date through a specified banking or online mode. So students, I'll just give some example. There should not be any confusion on this particular part. Here students make mistake and therefore just be very clear about it. Supposingly, students, as you know, generally you would know that there is a token payment that is done before the agreement, in fact, is entered between the buyer and the seller. The buyer will give some token amount. Then the question is that that token amount that he is giving, say for example, that is any amount. So token amount that he is giving should be that the part amount has been paid, part of the consideration is paid. That part has to be paid, students, through the specified mode only, which means that generally you might find that there are buyers who say that I will give you 10%, take it in cash. And the balance, probably I will make the check or demand draft, or I will take the bank loan, and through the bank loan, I will make you the payment. But the fact remains, before the agreement has been entered, a portion of the consideration was being paid, then whatever has been paid before the agreement, whatever has been paid before the agreement, if it is not through the banking channel, if it is not through the banking or online medium, in such particular case, students, you will not be getting the benefit of this particular exception. What is the exception? Exception allows you to adopt the stamp duty value as on the date of the agreement. But that comes with the attached condition. And what is the attached condition? That if before the agreement, if any consideration, whatever is the consideration that you may have received, either in part or in full, whatever consideration you would have received, that consideration amount, students, you should have received in the through the banking channel only. If you are receiving that particular amount through the banking or online medium, then and only then the stamp duty value to be considered for comparison purpose will be the stamp duty value as on the date of agreement and not date of registration. Is that clear to all of you, students? So the part or whole amount, whatever is the consideration that you may have received before the date of the agreement, that amount of consideration should be received through banking or online mode. There should not be any confusion. Now, students, there is a list of this entire thing. You don't have to by heart this particular part. You just have to only, these are things that was also there in our PGB chapter. The banking mode through which the payment has to be made of an expenditure on a single day in excess of rupees 10,000. Same banking mode is now universal. Okay. So that is precisely the point that should always be considered in this case. So if you satisfy the condition, students, then the stamp duty value as on the date of the agreement will be applicable, or else it is a date of registration that you will have to consider. If the question is silent, students, then what are you going to say? If the question does not talk anything about the the amount, the mode in which it has been paid, or it does not talk about that before the date of agreement any consideration has been received, the question is silent, obviously then you have to go with the main provision. And what is the main provision? Stamp duty value as on the date of registration. This is like an exception only to be considered. Now, students, in the last lecture, I have told you one important point, and that is about, please ensure that when you talk about the capital gains or so, in the last class also I taught you that don't only think from the transferor point of view, see if there is there any implication on the transferee as well. Is there any implication on the transferee as well? So the transferor, students, so the seller or the transferor, in this case, he gets the hit of capital gains. Okay, on the real estate transaction, say for example. But I told you, be very careful. The transferee students may end up having one important provision. Now, the next chapter, students, is the gift tax, sorry, IFOS. And in IFOS, this is one of the most important particular provision, which is about the gift tax provision, which was in earlier section 56 of the old law. In the new act, it is section 92. So over here, students, for the transferee, in this context, there is section 92. Always keep this point in mind, because the institute would be in the examination, students, you may find yourself into this particular aspect about the question may be started with the transferor, but they will have something to do with the transferee also. So what happens to a transferee section 92M, students? So what I have done is that I have reproduced this provision here itself. So rather than doing it separately under the head IFOS, we do it for here. But again, I am repeating what I have told you in the last lecture. Students, 92M provision of gift tax is not only applicable only for the cash gift. So don't make no mistake to think that cash gift received in excess of rupees 50,000, the gift tax provision is applicable? No, it does not only restrict to the cash gift. It also extends to the specified movable assets. Remember that jewelry, work of art, paintings, and shares and securities. And then thereafter, the immovable asset that we are discussing it right now, which is about this. You discuss the immovable property, as good as, students, the movable property provision gets covered in that scenario. Only thing, in the case of immovable property, there is the uniqueness of the stamp duty value. So what happens, students? I have received the immovable property without consideration, without consideration. And the stamp duty value is more than rupees 50,000. Then, students, whether the provision of gift tax, will it be applicable? Answer is yes, it is applicable. But students, if this is covered, for example, I have received it from my relative as a gift, or maybe through inheritance, or through will, or through succession, I'm receiving it. No? I've not paid any consideration. I happen to receive it. Tell me then, in that situation, whether the gift tax provision in such particular case, will it be applicable? Will it be applicable? Gift tax. Will it be applicable, students? The answer is no, it will not be applicable, isn't it? It's a tax. It should not happen, students. Please understand. It cannot be a case where I have transferred the asset. In this case, the transferor has got no particular tax implication, because his situation is covered under section 70, transaction which is not covered under the taxable transfer. But the recipient to whom Section 70 does not apply, because for recipient it is IFOS. Section 70 is for capital gains. Capital gains is for the transferor. So for recipient, Section 70 is not applicable. So whether the recipient will have to face the music? And the answer is no. Because if in the hands of the recipient, if you are taxing the amount, and then subsequently when the recipient will sell that particular property, then for that recipient, can you then take the cost to be the cost to the previous owner? Can you take that? No. The concept of cost to the previous owner has arisen only because the entire transaction was tax neutral, both for the transferor as well as for the transferee. If in between you are imposing a tax to the transferee and the transferee subsequently have to transfer that particular asset, then for that transferee on the subsequent transfer, can you take the cost to be the cost to the previous owner? Again, the answer is no, because he has already paid the tax up to the stage of receipt. Then how is it that then you will then again go back to the old cost, that is the cost to the previous owner? You can't do that, isn't it? And that is the reason why very carefully in the gift tax provision they have ensured that this exception is written there in section 92M. And what is the exception? That if you have received if the asset has been received as a gift from the relative or through that mode which is specified in the section 70, in such particular case the gift tax provision will not apply. The gift tax provision will not apply. I hope that all of you are clear with this one, students. And that's quite logical, isn't it? Otherwise, there would be a danger of double taxation. That is the reason why that not to happen, that they have ensured to create that level of exclusion even in the case of gift tax, so that the double taxation does not arise. So students, let's now read down the provision. So if now we come to the immobile property, say immobile property. So other than that particular case of exception, say all the remaining cases, on that the gift tax provision is applicable. Other than those cases of exception which we just discussed, in all other cases the gift tax provision will be applicable. But when it will be applicable, let's have a look. If that particular asset has been received without consideration, so the position has been given to you, if stamp duty value exceeds rupees 50,000, the stamp duty value is charged under the head IFOS. Under which head runs the IFOS? Obviously. So if the stamp duty value exceeds rupees 50,000, then the entire stamp duty value, again don't make the mistake, students. Don't take the excess over and above 50,000. Entire amount, students. The entire amount of the stamp duty value will be subject to gift tax. If it is for inadequate consideration, what do you mean by inadequate consideration, students? The difference means some consideration has been paid by the buyer. I am the buyer, I have paid some consideration. But the consideration which I have paid and the stamp duty value applicable, that there's a difference between the two. Means the stamp duty value is higher as compared to the consideration what I have paid. So the difference, if that difference exceed rupees 50,000, then the entire difference amount will be charged to tax in the hands of the buyer. In the hands of the buyer, students, in this particular context. And that is how the things has to be looked upon. I just want to ask you, if okay, before I ask you the question, students, again the same thing. You will ask, sir, which stamp duty value to be taken? Whether it is a date of registration or it is a date of agreement. Same thing, students. What I have taught you just now. Date of registration is the general rule. But you will take the stamp duty value as on the date of agreement if the conditions are satisfied. And what are the conditions, students? The condition is that if on or before the date of the agreement, if any consideration, whether it is in part or in full, if any consideration has been paid through the banking or online mode, then in such particular case, the stamp duty value on the date of agreement shall be adopted. And that's exactly what it is. My question here, students, is this now. I want an answer. Let me see how many of you can give this answer. I have already given you enough logic of how the entire structure of capital gains provision has been put up. And now let's see if you can answer this or not. Supposingly, here it is, Mr. A. He's a seller. Okay. Now, students, this Mr. A, the seller, has transferred this particular asset in this context. Say the stamp duty value, whatever is the applicable stamp duty value, is say 2 crores, and the full value of consideration, students, is say 1.5 crores. Okay. Mr. B is the buyer. Mr. B is the buyer. Now, 92M IFOS. Is it applicable? Yes, it is applicable. How much of the amount that will be taxed in the hands of Mr. B under the head IFOS? In this case, when he receives this property, what is the amount on which Mr. B will be subject to tax under the head IFOS? It is 50 lakhs. 50 lakhs. Why? Because the difference, if you see, which is 50 lakhs, that difference is it more than 10%? Is it more than 10%? Yes, it is more than 10%. Obviously, you can just calculate. So, if you see in that scenario, 1.5 crores, 10% you will take, and just check the difference, which is 50 lakhs, which is much higher as compared to the 10% of the full value of consideration. So, entire difference, and this difference, does it exceed 50,000? Yes, it exceeds 50,000. So, students, here also, the buyer gets that 10% threshold. So the 10% threshold we have to see, because if supposedly if it is the 10% limit, but here there are two limits for the buyer, students. There are two limits which is applicable. One is the 50,000 limit and the 10% limit. The 10% limit, and whichever is higher is what has to be seen. So in that situation, obviously 50,000 limit always exists. 50,000 limit is there for the buyer. So the difference, which is 50 lakhs, is exceeding 50,000. Yes. Is the difference exceeding that? More important, students, 10%, which is 15 lakhs. So is the difference exceeding this? Yeah. So your limit would be 15 lakhs. Why? Between the two, you have to take the higher limit. Between 50,000 and 10% limit, you have to take the higher amount, students. So the higher amount is 15 lakhs. So 15 lakhs will become the limit in this case. 15 lakhs will become the limit in this case. So therefore, you will take 15 lakhs, and then 15 lakhs will be compared with the difference. See the difference? Difference is 50 lakhs, 50. So your final particular point would be that since the difference exceed the threshold limit, and the applicable threshold limit we are taking as 15 lakhs. Why not 50 lakhs? Why not 50,000? Because 15 lakhs is more than 50,000. So we are taking, students, the 50 lakhs difference, and that will be taxed under the head IFOs in the hands of Mr. B. In the hands of whom? In the hands of Mr. B. The entire rupees 50 lakhs would be taxable, students, isn't it? After this, say for example, students, after this, students, let's see Mr. B has sold the asset. Let's stretch this particular part further. Mr. B has sold. Mr. B sold the asset. Okay. So he will calculating the capital gains. Mr. B will calculate the capital gains. So when Mr. B will be calculating the capital gains, students, when Mr. B will be calculating the capital gains, whatever full value of consideration, say the selling price, what shall be the cost of acquisition for him? What shall be the cost of acquisition? This you need to answer this part. What is the COI in this particular context, students? And the COI would be, let's see. Kanaya, Yogendra,
Sir, it is 2 CR
all the remaining
because
students.
1.5 CR was paid and 50 lakhs also taxed. So we are considering 2 CR.
Exactly. If you don't do that, as Yogendra would have said it, In this case, if you don't do that, students, you are in the danger of double taxation. Charita, agreed? You will have to take 2 crore, because if you take cost to be 1.55 CR, what the consideration that he has paid, then to the extent of 50 lakhs, there will be double taxation, because if the cost is lower, the gain is higher. And the gain to the extent of 50 lakhs was already taxed earlier under the IFOS. So therefore, you have to ensure that you adopt the correct cost of acquisition so as to avoid the cases of double taxation, students. So as to avoid the cases of double taxation. Charita, Radha, I hope that both of you are clear with this one. Fine, perfect, very good. So therefore, students, this is how the things has to be looked upon, and now we proceed further. So students, now then, I think this is one thing that I just wanted to ask you. And now let's proceed further, students, in this case. So this is about one important provision, students, which is to be considered. Now, students, this provision, when you talk about it herein, please understand the real estate which you are transferring, namely land or building, it can be either a depreciable asset or a non-depreciable asset. Non-depreciable asset, no issues on that. But even if it is a depreciable asset, students, in that context also, this section 50C being a special, sorry, this section 74, students, and 75, they are the special provision in that scenario. Therefore, even in the case of a depreciable asset, students, you will have, and which is building, you will have to take up the stamp duty valuation itself. That is one thing that you have to be careful about it. Okay. So this is applicable to a real estate property, irrespective of what, students? Irrespective of whether it is a depreciable or non-depreciable asset. Okay, so therefore they have not said that this is to be made applicable only in respect of a non-depreciable asset. That is not the provision. It is universal. And that is the reason why, students, you have to be very careful about it. This question is quite simple one, students, but before, if I, in fact, we can run through this question also. Proportionate thing is there. I just want to get an answer from all of you. And let me see how many of you can crack this code. How many of you can crack this code is what I need to just see. So as to see where exactly you people have reached in terms of a very advanced interpretation of the provision, students. This is a very, very advanced interpretation of provision. So that is what I just wanted to discuss with all of you right now. Let's see how many of you can give me the answer. Students, say for example, students, be careful. This is a case of, say, Mr. A, he has purchased a capital asset. Mr. A has purchased a capital asset. Say the capital asset has been purchased for rupees 1 crore. The capital asset has been purchased for rupees 1 crore. Now, somewhere in between, he converted this capital asset is, say, land. Okay, this capital asset is, say, land. Now, be careful what I'm saying, students, just have to pay attention. There is a conversion, although such question has not been targeted in the examination till date, but still, conversion of a capital asset into stock in trade. Into stock in trade. So the land which was there, that has been converted into a stock in trade. And as on this date, students, be careful. As on this date, the fair market value, as on this date, students, the fair market value is, say, rupees. Let me put a number now. The fair market value, students, is, say, rupees 1.5 crores. The stamp duty value is, say, rupees 2 crores. Okay. And then subsequently the stock in trade is sold. The stock in trade, students, is sold. Subsequently, it is sold. Students, we know that this particular provision we have already discussed, conversion of capital asset into stock in trade. We have discussed that though this is a transfer, though this is covered in the definition of transfer, but the chargeability is not in the year of transfer, which is the year of conversion. The chargeability is not in the year of transfer, which is the year of conversion, but the chargeability is postponed later when the stock in trade is sold. The chargeability is postponed later when the stock in trade is sold. That is what we have discussed, students, isn't it? My question to all of you over here is, what should be the full value of consideration to be adopted? Should it be 1.5 CR? That is the fair market value, or should it be the stamp duty value, which is 2 crores? What is your take on that? I need an answer for this. Land, huh? This is a land, by the way. It is a land which has been transferred. If you can also copy down this case study, students, because will give you a couple of notes. Some couple of sentence, students, just to make a principle clear in your mind. Do copy down this particular part, students, of this capital asset of Mr. A being the land, which was subsequently converted into the stock in trade when the fair market value was 1.5 CR and the stamp duty value is 2 CR. And later on, the stock in trade is sold. At what price it is sold and all, that these discussion I'm not having it. My focus is right on this. Just ensure to quickly copy down this one, students.
Sir, may I try this?
Yeah, please say.
Good evening, sir.
Good evening, Kanaya.
Sir, in this situation, sir, as capital assets is being converted into stock in trade, so there is no sale, sir. It is only conversion of land into stock in trade. So in that situation, sir, we should not consider the SGV. We should only consider the fair market value as on the date of conversion, because we are not receiving a single penny from the buyer. So in that situation, I think we should consider fair market value only, that is 1.5 CR.
Okay, I'll take that. And then in that situation, while I was getting to your explanation, I'll twist this fact further because I want to bring down one important note. Your answer is right. May I say, Kanaya, straight away, your answer is right, 1.5 CR. And your explanation is also plausible because obviously that stamp duty value independently cannot come on its own. The stamp duty value can come only when the consideration is involved. So it directly cannot say that in all the cases when the real estate is sold, that the stamp duty value would be adopted. That is now never a provision. The provision requires the stamp duty value to have a fair comparison with the consideration. We have a tolerable limit of 10%. If the difference exceeds that 10% threshold, only then that stamp duty value gets adopted. I agree to this point. Let me then give a twist in this particular case study. I take another case study now. Supposing instead of this, compulsory acquisition by law. The government is doing the compulsory acquisition. And say in year number 2, the government has compulsorily acquired your property, say for 200 lakhs. And in year number 3, they have given the first installment amount. In year number 3, they have given the first installment amount, which is rupees, say, 140 lakhs. What we have learned is that the year in which the SSC receives the first installment, that is a year where he will do the entire computation of capital gains. The year when he receives his first installment, that will be the year when he will do his entire computation of capital gains. Now, in this scenario, it is year number 3. Now, when he computes his capital gains, the full value of consideration now that he has to adopt, the full value of consideration that he has to adopt, will it be the entire compensation of 200 lakhs? Or, and now I'll tell you that, by the way, this compulsory acquisition was of land. The compulsory acquisition was of land. So the full value of consideration that you will adopt will be entire 200 lakhs. That is option number 1. Or the stamp duty value prevailing of that land in year number 3, which is, say, rupees 250 lakhs. Say rupees 250 lakhs. So here he has received the consideration amount. And the difference, what you talk about it, which is 50 lakhs. That difference is higher as compared to 10% of 200 lakhs, the consideration amount. So in such particular case, we may then say that, sir, in such case, the difference, because it is higher than the 10% amount, you will go with the stamp duty value. So in such case, again, the question arises, should I take the compulsory acquisition amount, which was being fixed, which is 200 lakhs, or should I take the stamp duty valuation in this particular case? What?
Sir, may I tell you, sir?
Yeah, please say.
Sir, what I think, sir, as the compulsory acquisition has been done by the government, so government is paying the value as per their calculation, and as government has fixed the amount, so that amount should not be exceeded by some other amount like HDV. So in this case, we have to consider only 200 lakh rather than other
Again, the
stamp duty.
answer is perfect. The 200 lakhs is the answer. So the final answer is right. You will not go wrong in the competition. But I will refine your reason now, Kanaya. And all the students, just pay attention to this one. Students, understand these sections where they have defined what should be the full value of consideration. These sections, that conversion of capital asset into stock in trade, they are contained in section 67. Which section? Compulsory acquisition by law is also section 67. In 67 only, they have told that the full value of consideration would be the amount which is agreed to be paid on compulsory acquisition of the property. In conversion of capital asset into stock and trade, this case is also covered in the charging section, which is section 67. In 67, it is told that the full value of consideration will be the fair market value as on the date of conversion, which means that the chargeability is on a particular amount under this head, which is capital gains. So when the charging section itself fixes an amount, then in the computational part, when you do your computation, the computation cannot go beyond what the charging section says. So if the charging section has said it is the fair market value as on the date of conversion that has to be taken, you will have to only go with what is charged. So while you do your computation, you will have to only go with what has been charged. And what has been charged, students? It is the full value of consideration, which is, in the case of conversion, what it is? Fair market value. In the case of compulsory acquisition, it is the amount which is compulsorily acquired. So once they tell you what has to be the charge, what should be the full value of consideration that will be adopted in the charging section itself, then you cannot go beyond the mandate of chargeability. This valuation of stamp duty value is an independent valuation provision, but the valuation provision cannot exceed the charging section. So if the charge is on a particular amount, the valuation provision cannot exceed beyond what has been prescribed in the charging section itself. So if the charging section says this, then this is the only amount that has to be adopted. Independent valuation provision cannot go beyond the charge. I hope that all of you are clear with the reasoning that you are supposed to tell. while getting to your answer, students? Fine. Please take a note quickly, students. The issue under consideration here, I hope that all of you have copied on this case, and now the issue under consideration is whether the full value of consideration, the full value of consideration to be adopted, the full value of consideration to be adopted should be the fair market value, the fair market value as on the date of conversion, or it should be the stamp duty value as on that date. Or it should be the stamp duty value as on that date. Question mark. Next slide, right, students? The fair market value, as on the date of conversion has been defined as the full value of consideration has been defined as full value of consideration in the charging section itself, that is section 67 subsection 6. That is section 67 subsection 6. Full stop. The adoption of the stamp duty value as the full value of consideration is provided in the independent valuation mechanism under section 78 read with section 91 full stop. Once the charging section, once the charging section creates a charge on a particular value, creates charge on a particular value, then it is only that amount, it is only that amount that that has to be adopted, that has to be adopted in the computational provision, in the computational provision. That is, the computation cannot go, the computation cannot go beyond the amount, cannot go beyond the amount on which the charge is created, on which the charge is created. Is that point clear to all of you, students? Fine, students? Perfect. So this is a principle that you should always know. It's a universal principle. So therefore, knowing that this is a charging section, this is a computational provision, this becomes very important. You should know that this is my charging section, this is my computational provision. And when you read a charging section, always see carefully, is the charging provision also provides for an amount on which the charge is created. And if it does, then subsequently when you do the computation, that computation cannot go beyond what the charge has provided for. I hope that I'm very clear on this particular proposition before all of you. Fine, students? Perfect. Now, let me ask you, if I don't know whether you would have, the students generally miss this particular point. Students, tell me one thing. If for a real estate dealer, for a real estate dealer, he is under the head PGBP. He is under the head PGBP. So when the real estate dealer, when he sells that particular real estate, namely land or building, then that selling price that you will adopt for the PGBP purpose, what it will be, whether the same particular principle, whether the same particular principle of stamp duty value, will that be also applicable to a real estate dealer or not? Answer is yes, students, it will be applicable. Stamp duty value would be applicable, students, to a real estate dealer also. In this context, the provision under the head PGBP also ensures that the real estate dealer cannot cannot go with the undervaluation by selling, by showing sales an amount which is lower than the stamp duty value. So for him also, the stamp duty value is something that is a litmus test as well for the real estate dealer on whom the head PGBP is what is applicable. Fine, students, just keep that particular point in mind. And now with that, let's proceed, students, further to our next particular part, which is about the joint development agreement, students, here, JDA. Students, this is covered in section 67. So anything which is covered in section 67, 68 and 69 under the head PGB, sorry, under the head capital gains, these sections are nothing but, students, the charging section. The charging section, students, isn't it? 67, 68 for liquidation, 69 is for buyback. Now, there is a concept of joint development agreement also, students, which is there in the chargeability. Now, what is this JDA, students? I hope that all of you are aware of it. If not, then I'll just give a quick example so that you may also copy it if you do want, so that what happens to the JDI, joint development property? Though no question has been asked in this case, but still you should be knowing about this concept per se. It's an important one. Lot of redevelopments happens, students, that you may be aware in this context. So you will find that there is a particular person who is a real estate owner many a times. REO, I'm just writing short form, real estate owner. And then there is a builder, students. Now, this person has got a real estate, say land. He has got a real estate, but obviously he does not have a fund or skill or that labor to do the construction activity. So what he does is that he approaches the builder and they do an agreement. That sort of an agreement is known as the joint development agreement. Now, as per which the real estate owner is required to give his land. Now, the land would be given to him, to the builder. Now, students, be careful. In the last lecture, students, we have discussed, last or maybe last to last lecture, I'm not aware, but we have discussed this part that as far as the immovable property is concerned, if you are giving the possession of your immovable property as a part performance of the contract, then that particular possession, by transfer of that particular possession as a part performance of the contract, this will be referred as what? As a transfer. Isn't it? That will be referred as what? As a transfer. And if it is transfer of a capital asset for the real estate owner, this is a capital asset. So in such particular case, the capital gain chargeability will be attracted. In such a particular case, the capital gain chargeability will be attracted. In whose hands? In the hands of the real estate owner. That is what the things would be in this regard, isn't it? So therefore, in this context, now the situation will be here, he has transferred through the possession means. He has given it to the builder. Now, if supposingly the question that arises, students, over here, and let's say, for example, let me, before I get into the chargeability mechanism and tax implication, let me complete a transaction for you. Now, what the builder would give it back to the real estate owner? I have taken your plot. Now, what I will give, say, for example, I, as a consideration, he agrees to pay, say, for example, a consideration amount. He agrees to pay, say, 10 CR plus, say, 3 flats in that new building, but which I'll construct, isn't it? In the new building, students, which the builder will construct. So he agrees to give him 3 flats. Now, what happens over here? So the consideration is what is in the form of monetary and non-monetary combined together. Now, if you go with the first charging section, 67 subsection 1, what does 67 subsection 1 says? That if there is a transfer of a capital asset, then the gain arising on that transfer will be chargeable. In which tax year it will be chargeable? So the tax year in which it will be chargeable will be the year in which the transfer has taken place. And just imagine this, students, the transfer has taken place. Now just imagine here the transfer may have taken place, say in year number 1. The consideration in the form of, say, money, he may receive the money. But what about that non-monetary consideration that he is receiving? That he will receive quite late. And then if you would try to tax him in the very first year itself, when he has given up the possession, which is equal to transfer. So in that very year, if you want to tax him, then it will be quite unjust to him in this case. It will be quite unjust to him in this case, isn't it? And that is the reason why, students, there is a special chargeability under section 67 for this joint development agreement. For this joint development agreement. And what is this one? Students, they say is that in this case, just a second, just let me confirm, 67 subsection 12 and 14. Sorry, 14 and 16. Just a second, let me confirm one, students. Yeah, 14 and 16. So here, students, here to save this transfer, students, a special chargeability is attracted. Special charge. Special charge under section 67, 14 and 16. And what it says? it says that the year of chargeability will not be the year of transfer. What is the year of transfer, students? The year of transfer is the year when he has given the possession as a part performance to his contract. That is the year of transfer, isn't it? So what they have said is that the year of charge will not be the year of transfer, but it will be which year, students? It will be which year? It will be the year in which, be careful, students, the year which will be tax year. Any guess, students, of this one? When the new building, students, has received the CC. So what is CC? Completion certificate. So when the new building would have received the completion certificate, that will be the year of transfer for whom? For this real estate owner. So can we say by adopting this, what they have successfully done? They have postponed the charge. What they have done, students, successfully, they have postponed the charge, and that is what they have done, it, students, over here. So therefore, for the real estate owner, the year of charge will not be the year in which what? In which the real estate has been given, which is the possession has been given. But it will be the year in which the completion certificate to that new project is received. Now, just now, students, very importantly, so here, can I say therefore it is postponing the charge? Postponing the charge, isn't it? That is point number one. And point number two, students, this is also defining what will be the full value of consideration to be considered. And the full value of consideration, students, to be considered over here would be this monetary plus what? The stamp duty value of what? Of the building, the new building he receives as consideration. He receives as what? As a consideration. So he receives 3 flat, isn't it? So whatever is the stamp duty value of that flat, that will be considered as what? As the full value of consideration. Be careful, students. Now, I have just now taught you a principle. And what is the principle? Principle which I have taught you is that if the charging section has got, or if the charging section has defined what will be the full value of consideration, then you are only supposed to stick on that particular value. You just can't afford to go beyond that particular value. You just can't afford to go beyond that particular value. I hope that every one of you are now clear with this one. Now, therefore, again, to confuse you, they will give you 2 options. Option number 1, these could be the possible MCQ based question. And the option number 1 would be, they will tell you that the stamp duty value of the land which he has given, stamp duty value of the land that he has given is, say, rupees 35 crores. Okay? And what he has received is 10 crores amount, plus the 3 building was of, say, 20 crores. So total, if you do, it becomes 30 crores. And the stamp duty value of the land that he has given to the builder is 35 crores. So therefore, the question that might be targeted to you could be that should I consider 35 CR or should I consider 30 CR in this case? So students, this principle is what you need to remember. That 30 CR as the consideration amount, is it defined in the charging section itself? Answer is yes. And if the answer is yes, students, then that independent valuation provision will not be applicable in such particular case. We have to charge only what has been defined in the charging section itself. So this is what exactly the things comes up with. I hope that every one of you are now clear with this particular point, students. If you all are clear with this one, students, I'll just very quickly, we'll run through this one and that should be all primary. Just keep the concepts in mind, students, everything becomes clear. Otherwise, you will keep remembering the provision, which will not help you at all. Remember the key principle of law, how the interpretation of law. Once the principle is clear in your mind, you will not make any errors. Now, if you see over here in this context, just have a look. Over here. Eligible transfer. Who is eligible transfer? It is either the individual or the HUF. What is the asset that has been covered? Land or the building, students? Land or the building or both? What is the nature of the agreement, students, over here? registered land or the building students in this regard? What is the nature of the building students? What is the nature of the building in this context? So if you see over here, nature of the agreement, registered agreement, registered specified agreement under which the owners allows another person to develop real estate project for a share in the land or building. So what I'm going to get in return, what I'm going to get? I'm going to get a share in that land or building in the project with or without monetary consideration. In my example, he is receiving some monetary consideration also along with the share, which is 3 flats in my example. Now see the year of charge. If you would have gone with the general charge, students, if you would have gone with the general charge talks about the year of transfer. And what is the year of transfer in this case? The year when he has given the position. The year when he has given up the position, that is a year of transfer for him. So whether that will be the year of chargeability? No. See here, the tax year, the tax year in which the competent authority issues the completion certificate for the whole or part of the project. So the year of CC that he receives for the whole or the part, that will be the year of chargeability. Value of consideration, what is the value of consideration? So whether the charging section is defining the value of consideration, and the answer is yes. So what is the value of consideration? Stamp duty value on the date of completion certificate of the owner shares in the project. Okay, so stamp duty value on which date? On the date of agreement? On the date of registration? No, on the date of the completion certificate. See here, the stamp duty value of the consideration, which is the building, is the date of the completion certificate plus the monetary consideration that he has received. That is the reason why I took that amount. And that exactly is the point, students. So therefore, students, just keep this. See, this is how the things become simple now. If you learn the principle, students, it becomes quite simple in this regard, in this context. Now, students, there is a CBDT circular in the module which has been given. Uh, this is for the under construction of the flats. One circular, old circular, as you know, students, old circulars are also applicable by virtue of the saving clause under section 536. By virtue of the saving clause under section 536, students, old circular students are also applicable in this case. Radha is asking, sir, it's not SDV where it's FPC as given in chargeability provision. Radha, can you be in the speaker? I need to understand your query.
Sir, actually, you read in that section na, that it's SDV, but actually the chargeability section is the only one na, which is provided for it. So I was confused with that.
No, the generally that independent valuation of section 78 read with 79. Rather, just pay attention to this particular part. 78 read with 91. This section talks about SDV. SDV of what? SDV of what you have transferred. So SDV of the transferred real estate. This is what this provision says. SDV of the transferred real estate. That would be compared with the actual consideration received and that 10% tolerable band. That is what we learned at the start. This section that we are referring for the joint development agreement, which is section 67, subsection 14 and subsection 16. They are taking what? Full value of consideration, what they are taking? They are taking the consideration amount that he has received plus of what? Plus the stamp duty value. Plus what? The stamp duty value of what? The flat that has been received. What the flat that he has received. So in that particular case, rather, what you are talking about, the definition of full value of consideration in the charging section for joint development agreement only is the amount that he has received, money, which in my example was 10 crores, plus the stamp duty value that 67 subsection 14 only says the stamp duty value of the flat that you have received. That is the stamp duty value that you have to take. Plus the monetary consideration, if you have received the monetary consideration, which was there in my case. So now the combined fair value, full value of consideration is this amount. That is what is charged under section 67, subsection 14 and 16 respectively.
Okay, that means that's the special provision over here, which is actually giving a overriding effect than what we learned. We
Yes,
can say
what
that.
in the independent provision, because what we have learned in the context of the independent valuation provision was the land that or the real estate that you transfer, that real estate stamp duty value should be taken if it is more than 110% value of your consideration amount. That is what the independent valuation provision says. That whatever is the real estate that you have transferred, you will take the stamp duty value of that real estate if it exceeds 110% of the consideration amount. Okay, that's an independent valuation provision. So the emphasis of the independent valuation provision is on the stamp duty value of the real estate that you have transferred. Whereas here, in the context of 67 subsection 14 and subsection 16, the emphasis is on what? Is on the real estate, what you have received plus the monetary consideration, their value will become the full value of consideration.
Yes, sir. It is very intricate, but I understood.
Got it? Right? So therefore, this is how the full value of consideration needs to be considered. So students, that is what it is in this regard. Now students, coming on this particular part of the period of holding of an under construction flat. This is just a circular. Now students, what would be the period of holding that will be considered? See, what happens is that if you remember in the context of, like I take up from the builder, first I pay a token money, then application form is filled, then there is an allotment that happens, and post the allotment, then thereafter the possession is given. That is the entire hierarchy. So from which date the period of holding should be considered? Should I be considering the period of holding from the date when the application form was filled by paying a token? Or should I be considering the period of holding from the date when the allotment was made by the builder? Or should I finally take this particular period of holding from the date when I took the possession of that flat from the builder? So for on that context, students, they have given. Now this can happen, students, only when there is an under construction flat. If you have got a ready-made flat, it is go and enter into that flat itself. That way, the date of agreement in this context, or the date of possession, as the case may be. But in the case of this entire scheme of a newly constructed building, where I'm putting my money. So when I'm putting my money, first is the application date, another is the allotment date, and the third one is the possession date. So when that particular building is sold by me subsequently, I should be considering the period of holding from which date? From the date of application, from the date of allotment, or from the date when I got the possession? From which date I should start counting my period of holding? That is what this particular CBDT circular is all about. So therefore, the starting phrase itself is an important one, which is what they say. They say that for an under construction flat. Can you see this? For an under construction flat, students. So this is the point, students, that you have to be careful about it. Okay, so for an under construction flat, what exactly? Can you just let me complete this? In this case, so what exactly it is? So let's have a look. Identify the capital asset or the enforceable right that is transferred and apply 24-month test, because for real estate students we have got 24-month test, isn't it? Identify the capital asset or enforceable right that is transferred and apply the 24-month test to that asset or the right. Where an allotment is final, this is important, students. Allotment is final means after that the builder cannot cancel it and crystallizes the allottee's right. In this, he is crystallizing means freezing the allottee's right under a scheme of a kind considered by the CBD under this date. The allotment date is the acquisition date in this case. So you have to just see on the allotment of that particular flat. Do I get an exclusive right? Obviously, I have to pay the installment. Obviously, the builder has to do the construction. But in respect of that future property which has been allotted to me, do I get a full right? Because please understand, I need to have an exclusive right once the allotment is done. If you say that no, no, sir, the builder can cancel your allotment and he can sell as per his discretion to anyone else and he can just pay you off some compensation. If this is what you're talking about it, then I don't have any exclusive right, isn't it? But generally, it never happens that way. In a real estate transaction, the moment in an under construction project, when you do the booking, you check the agreement. In the agreement, technically, you have become an exclusive right. Obviously, you have to make the payment. You can't be a default. But does the builder can cancel the allotment by his own discretion, pay you the compensation, and sell this particular flat to any other person? This cannot happen. And therefore, it is a date of the allotment where you get the exclusive right. And since you have got the exclusive right, it becomes the property. In a way, it becomes a capital asset. And from that date onwards, till the date you transfer, this is what will be considered for the purpose of the period of holding. And if it exceeds the threshold of 24 months, it is a long term or else it is short term, as the case may be. Is that point clear to all of you? So this is to be considered, students, for the under construction flat. For the under construction flat. Yes, Kanaya, I'll take it. Before we go to the next particular query, you can just switch on the my speaker and then ask the query.
Sir, I have a couple of doubts, sir. When we discuss about the section 67, subsection 14 and 16, sir, it is only available for individual and HUF, sir, right? So, sir, in that situation, if individual and HUF are resident, then in that situation we can take the benefit of indexation, right?
Yes, he can.
And
He can.
the first
Good.
one is this. And the
Yes, he can. Yes,
second
he can.
question,
Yeah, please say second question.
yeah, my second question is, sir, like this is for individual and HUF. What about a society transfer their land for a builder for developing that land? So in that situation, what would
Normal
be
provision.
taxable?
Normal provision will apply. If it has to cover under 67 subsection 14 and 16, it needs to be within this parameter.
Okay,
67.1 will
individual and
go. They will go to 67.1.
okay. So in that situation, only available for individual and HUF,
Yes, 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 yes.
and other than these, they cannot available for other person,
Yes.
right?
Perfect.
And the sir, third question is, sir, when we transfer the land for development purpose. So, sir, for the chargeability purpose, we are deferring the transfer from the date of transfer to the date of actual receive of consideration in terms of money and flat,
Not we
right?
are transferring in the tax year in which the completion certificate is
Cha-
received.
yes, chargeability we are deferring. So, in that situation, sir, we would take the means indexation or indexation
Transfer. You have
rate.
to, unfortunately, Kanaya, the query that Kanaya has asked, it's a good one. Very good query. Let me, in fact, give a particular factual numbers for all the audience. Very good query. You can switch off this one. I'll explain through a query, a small example. So,
Thanks.
students, first of all, as you all are aware now, indexation is only applicable only in one particular case, doesn't it? So, that is prior to 2024, that cutoff date we have seen. That is also applicable only to individual and HUF, resident individual and HUF. That is what we have also seen in the last lecture. So, just building on his query, students, through an example now, all of you will take a note of it, students, because this will come across to his particular query in a very crystallized form. Good timing, Kanaya, of query, so that this concept is known to the students once and for all. Just pay attention, students, all of you. So, students, this was the real estate owner, REO. He has purchased the land for rupees 100. We'll also define year number one. Say year number year number 3, he has given the possession, given the possession, given the possession to whom? To the builder. Students, given the possession to the builder. Isn't it? So he has given the possession to the builder in year number 3. That by giving the possession, that is a transfer. Yes, it is a transfer. But though it is a transfer, is it chargeable in year number 3? No. 67 subsection 14 and subsection 16 ensures that the year of chargeability is deferred. Say in year number 6, so the transfer has taken place, yes. But the chargeability would be in year number 6 when he receives what? When the completion certificate CC of new building is received. CC of new building is received. Okay. And just to take it more complete, and say for example, students, by the way, this is before, this also just to complete this part, he has purchased before. What is the cutoff date, by the way? Can anyone tell me the cutoff date? Specific cutoff date. Before which, if you purchase or if you have acquired, only then the option
23rd
of
July
indexation is available.
2024.
What is that, Radha?
23rd July 2024.
23rd July 2024. Perfect. So before this data, because I have to give the indexation to him also. Okay? So this year 1 is before 23rd July 2024. Now, just let's take the things further. So the monetary consideration was say rupees 10 crore, my own example, original example. And the stamp duty value of the 3 new flats which he constructed is say 20 crores. Fine. Now, question therefore is, all of you just copy up till here, because we are building up to this concept. Copied? Okay. So students, just taking it further from here, year 3 will be the year of charge. Year 6 is where the charge will be attracted. Though the transfer is in year 3, the transfer, students, is in year 3, but charge is in year 6. Any specific section? Yes. 67, 14 and 16 is what is the specific provision for that effect. Fine. And now I'm going to do the computation also. So when I do the computation in this very year itself, the full value of consideration as per section 6714 will be how much? Will be 30 crores. 10 plus 20. Okay. Now this real estate owner is an individual. Yes, he is an individual. The real estate owner, students, he is an individual. And because he is an individual, first of all, I will have to just decide period of holding. Students, period of holding will be considered from which year to which year? Year 1 to year 3 or year 1 to year 5? Year 6, sorry. Period of holding.
Year
Will I
1
be
to year 6.
Sir, year 1 to year 3.
year 1 to year 3, because understand, he has transferred the capital asset, and after transferring he doesn't possess. Period of holding, rather period of holding as a capital asset. Is he holding a capital asset? Primary, is he holding a capital asset? The transferor, that is a real estate owner, is he holding a capital asset? See, just only go with this one, because this is, I think, second or third time wherein you are extrapolating to the charge. The word itself should be made very clear. You should write very clearly in your notebook, period of holding as a capital asset. And just try to always put your emphasis on this phrase, period of holding as a capital asset. So question is that first of all, he is not holding at all in this case. And the fact that he is not holding at all, because he has transferred, he has given up the position. Therefore, in that case, the period of holding would be from year 1 to year 3. And I have made you write what? Period of holding as a capital asset. Why I am making you write period of holding as a capital asset? Because I knew that there is a case of a conversion of a capital asset into a stock in trade. And in the case of conversion of a capital asset into a stock in trade, what happens? Even in that particular case, say year number 1, I have purchased a capital asset, say land. Year number 4, I am converting that capital asset into stock in trade. Okay. Year number 5, I am transferring the stock in trade. Okay. We know that in such particular case, the chargeability would be in year number 5. Which is the year number 5? The year in which the stock in trade is sold. In that very year, the chargeability of capital gains will also arise. That is in year number 5, when the stock in trade is sold, in that very year itself, the chargeability will arise. That is what we have seen just now also. Now the question arises, fine, when I am computing my capital gains, I need to know what is the period of holding of that capital asset for determining whether it is a long term or short term. So period of holding as a capital asset. So what I told you, year number 1 to year number 4 only. Don't take year number 5, because though he was holding till year 5, but was the holding as a capital asset? Was the holding as a capital asset? Answer is no. It is only held as a stock in trade after year number 4, which is not a capital asset, and therefore you will only restrict to year number 4. Here in this case, in this joint development agreement example, he is transferring itself by giving up the position. He has transferred. So he is not holding beyond year number 3. He is not holding beyond year number 3. And therefore, period of holding would be, though the charge is in year number 6, but he is not holding beyond year number 3. So therefore, period of holding would be from year number 1 to year number 3. And assuming it is more than 24 months, it will become what? Long-term capital asset. Long-term capital asset. Did you got this one, rather the concept now?
Yes, sir. I'm sorry to make this mistake.
Yeah. So just ensure na, see, you keep making mistake in the classroom, absolutely fine. Till n number of time you make a mistake, I keep explaining you n number of time. Absolutely perfectly fine. Don't make this mistake in the examination. That is very important. So no mistake of such kind should be made in the examination. So you keep hammering me with this particular thing, I'll keep answering this one. Absolutely not an issue at all. But this should not be replicated in the examination. Okay. So with that now, students, come to this particular part. So full value of consideration, 30 CR. Now coming to Kanaiya's query. Now say it is more than 24 months, so it is a long-term capital asset. So it's a long-term capital asset. So therefore you, and this is an individual transferor or HUF transferor who is the real estate owner having the land given to the builder now. Now he wants to check on that particular option that is available to him. Is the option available to him? Yes. Option is for those who acquired the land or building before the cutoff date. So he acquired it before the cutoff date. So accordingly, students, in that case, index cost of acquisition will be applicable. If he wants to, now I'm calculating his liability, but Kanaiya, Radha, Yogendra, there's one student's name I forgot again, and all the students. So in this particular context, this computation, please don't do it in your total income computation. This is to be shown in the tax liability as a working note. Okay, this computation is a tax liability, because computation I told you, in total income you will only do what? Full value of consideration minus COA. No indexation to be considered in the total income part. But when it comes to tax liability calculation, at that stage, I will check whether with indexation at 20% is beneficial, or without indexation at 12.5% is beneficial. That I will check, and that is what will be my liability from this particular transfer. So this is my working note calculation for the tax liability computation. So index cost of acquisition now. Now be careful, students. Index cost of acquisition. So what is the cost? Cost is 100. Cost of acquisition 100 into what comes in numerator and what comes in denominator. So be careful. CII have to be taken, students. CI have to be taken. CI of which year in the numerator in this case. So be careful, students. In the denominator, nobody will make a mistake. Denominator, CI of the year of acquisition. Year of acquisition. But what comes in numerator, students, is the CII of which year? In the numerator, students, it comes as the CII of the year of transfer. So here it is CI of the year of transfer. That is the numerator, students. That is what? That is the numerator. So in the numerator, it is CII of the transfer, and therefore the transfer is in which year? Year number 3. Acquisition is in which year? Year number 1. So whatever is the relevant CI given to year number 1, that is your denominator. Numerator, CI of year number 3. Again the same query. But sir, we are, but year number 6 is the year of chargeability. Yes, agreed. The chargeability is postponed. That is the only limited concept. But does not mean the computation will also get postponed. The computation has a cutoff, and the cutoff is till the date of transfer. And therefore, we take whatever is CI which is attributable to the transfer, which is year number 3. That is what will be my numerator. Denominator would be CI of year of acquisition. This proportion to be applied on your cost of acquisition. This is my cost of acquisition. So index cost of acquisition is what I'm going to reduce. And finally, I'm going to get my long-term capital gains. But this long-term capital gains is not for the purpose of this long-term capital gain, students, is not for the purpose of your computation of total income. It is to be taken as tax at the rate of what? Tax at the rate of 20%. Tax at the rate of 20%. And then you have to continue with your working note and then see the second alternative. What is the second alternative? Second alternative 2. What is alternative 2? 12.5% on LTCG without indexation.
Indexation.
Perfect. And then see alternative 1, alternative 2, where his liability is lower. That is what will go in the tax computation statement. That is what will go in the tax computation statement. Is that point, students, clear to all of you? Kanaya, your query?
No, sir. Thanks. Sir, one silly things are coming in my mind. Sir, in joint development rights, sir, whether there is any dilution of legal right on the property when we transfer the property to builder for
Any?
only developing purpose.
Oh,
In case
this is
of joint,
as the name suggests, it's a joint development. So there has to be a
so sir,
development of it.
is there any dilution of right taking place?
Dilution as in?
Dilution of right.
Yeah, you can say that way. Yes, yes, yes. I means
Be-
there is a, you can say, uh, there is a extinguishment of my right in the land now. Okay, the proper word would be Kanaya, extinguishment of my right in the land in favor of the builder. So I'm extinguishing my right in favor of the builder, against which he is giving me some money and also is giving me some new flats in the new building that he is constructing. That's my consideration. So on my existing land, the right is getting extinguished on account of this JDA.
So, one more thing. Like when I receive the flat from the builder, sir, so that flat when we sold those flat in near future, so date will be calculated from the date when we receive the new building or from the date when my right was there in the earlier years. Because
Again, come back. Means the new flat when you will sell it.
yes, yes. So
So
in
you,
that situation, sir,
and you are talking about the period of holding.
yes, sir.
So see, period of holding would be like, obviously I have. It's not that it's a exempt transfer, isn't it? It was a taxable transfer for me, and I have paid the tax. But the year of chargeability that has happened when I have received that asset, I have received in year number 6. So that became the year of charge. in that context. Now
No,
that
sir.
is the year when I have received that particular asset. Now what you are asking is this, that in when I sell the asset later on,
Yes, sir.
that particular asset, which is the new flat,
Yes, sir.
in that
Right.
case, what should be my period of holding?
Yes, sir.
The year of CC.
Yes,
The year of CC.
the years.
Okay.
Thank you, sir.
Okay. Okay. So with that, students, now let's come back to the concept again. Now, students, the next concept, students, is that of the forfeiture. This is also, students, I think these are things that you may have learned in your inter CA also. So we can just very quickly run through the same. Remember this advance money forfeited, students. What is the scenario? Now, students, you may be aware, same provision is now in the new law also. In the old law, the provision was there, same in the form of a new section 81. They have created the same thing or in the new law. So, students, what exactly it is? Students, remember this date. This date was an important one. And what is this advance money forfeiture? Very quickly, if I have to tell you the concept, let me tell you. Say I want to sell my building. Now you know that what happens is that many a times the buyer comes, he pays a advance money because he wants to buy. And once he pays the advance money, thereafter he does not perform his set of contract. And then what happens? I, being the transferor, I don't have any other alternative but to cancel the contract with him because he is not giving me the money. So I have to then cancel the contract. And not only that, I'm going to cancel the contract, I'm going to also forfeit the advance money that I've received. I'm also going to forfeit the advance money that I've received. So that forfeiture of the advance money that I've received, if that forfeiture would have happened before 1st of April 2014, then what they say, it will be reduced from your cost of acquisition. It will be reduced from the cost of acquisition. Which cost of acquisition? Means supposingly subsequently after say 4 years or 5 years, I finally sell my flat to another buyer. So when I'm selling the flat to the another buyer, then I will be calculating my capital gains. So when I'm going to calculate my capital gains, that advance money which I have forfeited in the earlier transaction, which is before 1st of April 2014, that forfeited money will be reduced from my cost of acquisition. And by reducing my cost of acquisition, students, obviously the long-term capital gains will increase in that scenario. The long-term capital gains will increase in that scenario. So that is what they are saying. The law says that, the government says that, look, you have received the benefit. Because please understand, they have used the word, you have received the benefit. And to the extent of the benefit that you have received on this particular property earlier, in the form of advance money which you have forfeited, that benefit you will have to reduce from the cost of acquisition. So therefore, the assessee will have to feel the pain and he will reduce from the cost of acquisition, calculate the long-term capital gains. That is first point. Point number 2, students. If any advance money gets forfeited on or after 1st April 2014, then the law has been amended. And what is amendment, students? The amendment that they have made is this, that now instead of reducing it from the cost of acquisition, whenever the assessee transfers the flat and when he compute his capital gains, at that time, instead of reducing it from his cost of acquisition, we will not, we will not reduce it. Instead, any advance money forfeited during this date or now from this date in the new law, this is the new law, students. This is the new law. So, any advance money which is forfeited from 1st April 2014 and in the new law also, it will be charged in which head? In the head which is IFOs. In which head, students? The head is IFOs, income from other sources. So therefore, you will have to see the question carefully and check out what time the advance money got forfeited. If it is before 1st April 2014, easy. So you will have to only reduce it from the cost of acquisition, Consequently, the long-term capital gains will increase. But if the advance money got forfeited later period, say for example in the current tax year, also say in the month of June 2026, students. So there was one advance, the house property I purchased in 2005. I made an attempt to sell the house property in 2012, for which I took an advance money of say 10,000. The buyer did not proceed further. So what I did, that 10,000 was forfeited by me. I made a second attempt in June 2026, current tax year, to sell that property. The buyer didn't, that buyer gave me 20,000 rupees as the advance money, but later on he also backed off. He also backed off. He didn't came forward later on. So there is a second advance money forfeited. Then somewhere in later in December 2026, finally I got a credible buyer and I sold the property. I sold the property. So I sold the property in tax year 26-27. Yes. Will I calculate the capital gains in tax year 26-27? Yes. Full value of consideration amount which I have received, that will be compared with the stamp duty value, considering it is a real estate. Less cost of acquisition. Now, cost of acquisition, students, there is one advance money I have forfeited before 1st April 2014. So, my original cost, primarily of 2005, I'll reduce it from what? I'll reduce from that particular indexed amount of 10,000. That advance money which I forfeited, that I'm going to reduce it. And that will become my students the real cost. That will become my real cost. Okay. Now you will say, sir, what about that advance money forfeited in the current tax year in June 2026, which is rupees 20,000? That advance money which I forfeited in June 2026, that is of rupees 20,000, it will be charged separately under the head IFOS. It will be charged separately under which head? Under the head IFOS. So this is what it is. Now again a query can come in the same particular case. A query can come in your mind, sir, what about that particular point of indexation and all? The same query, na? That particular thing. So my 2005, say my 2005, I purchased it for rupees 1 lakh. 2012, 10,000 was forfeited. 2026, 2026, 20,000 was forfeited. Okay, and then 2026, it was being transferred. Transfer for say rupees 10 lakhs. So 10 lakhs, say the full value of consideration. So accordingly, same thing, students. The costs, here we are here for the cost. Now see how it will happen. Option 1, option 2. In the tax liability computation, or two alternatives. In the tax liability computation, students, two alternatives. Alternate 1 and alternate 2. So what will be there in the alternate 1, students, in this case? And what will be there in the alternate 2? So far as the alternate 1 is concerned, say full value of consideration, this is with indexation. Full value of consideration 10 lakhs. Less, what will be the cost, students, in this context? So the cost of acquisition in this scenario, please have a look, students. So the cost will be 1 lakh, the original cost, minus this 10,000 which are forfeited in 2012. Now on the net cost, 90,000, I will apply the CI. CI of the year of transfer, that is of 26-27, divided by CI of which year? Say of 2005-2006. This is the index cost of acquisition, is what I am going to put it up. And from this index cost of acquisition, students, I am going to get what? My long-term capital gains or loss. Obviously, I'm going to get long-term capital gains. And what about alternate 2? And on this long-term capital gains, don't worry, be careful. Huh? I'm not going to stop here because this is not primarily our objective. This is our tax liability competition. So of this long-term capital gains, tax rate is 20%. Fine. Alternate 2, students, without indexation, full value of consideration, say it is rupees 20 lakhs. Sorry, 10 lakhs. Less cost. What is the cost of acquisition? 90,000. So therefore, on 9.1 lakhs, it will be taxed at the rate of 12.5. Now, whichever is the lower of the two option, that will be my final tax liability. But again, I'm repeating this point, students. Again, I'm repeating this point. In your total income computation, you will only show 9.1 lakhs. In your total income computation, students, you're going to show only 9.1 lakhs. You will not take into account this indexed long-term capital gains, even if alternative one is finally what you choose, because as per alternative one, your tax liability is minimal. But still, in the computation of total income, I will have to show my long-term capital gain as rupees 9.1 lakh, in spite of the fact that I am choosing alternative one as my option to pay the tax liability. And in the last lecture itself, we have discussed about the logic behind this. In fact, if I'm not mistaken, Kanaya and all, you all only have given me the answer. And what was the answer? That why the government wants to go with alternative, why the government does not, in the competition of total income, why the government is emphasizing that don't do the indexation, take up the without indexed LTCG. The reason is very clear, because without index LTCG increases your total income. If your total income threshold increases, chances are high that you might have to end up having a surcharge also in calculating your tax liability. That is the point, students, over here, and this covers up your advance money forfeited. But just one last point, students, which is a point which you should bear it in mind. So, students, what exactly is the last point? What about the advance money forfeited? Say, for example, if this asset was being received from my father, and say my father also made an attempt, he also made an attempt to sell this particular property to a particular buyer, but that buyer again backed off. And therefore, my father also ended up forfeiting some of the advance money. So, whether the previous year owner's forfeited advance money, will that be considered? And the answer is no, it will not reduce the cost of the son, that is SSC. And that exactly is the point, students. That exactly is the point. So, just keep in mind, students, this particular perspective over here. I hope that all of you are clear with this one now. Students, let's a, a small question, students, which you can do over here in this case. See the small, I think this is a module question. Illustration 5. Previous owner forfeiture and substituted cost. The SSC succeeded to a property acquired by the previous owner before 1st April 2001. Fair market value of 1/4/2001 was how much? 2,70,000. And stamp duty value, students, was 2,20,000. Tell me one thing. This, I think we have discussed this particular part. If you have acquired a property before 1st of April 2001, then students, you have to be very careful on one thing. We take always the fair market value primarily of the property. However, if it is a real estate, students, you have to be careful on this part. The fair market value as on 1st April 2001, if it exceed beyond the stamp duty value as on the same date, then you will have to then take the cost as the stamp duty value as on 1/4/2001. You will have to take what, students? The stamp duty value as on 1st of April 2001, and the stamp duty value, students, how much it is? 2,20,000. So this is what would be the value to be adopted. This is for the real estate, because only in the real estate this particular provision is what is the stamp duty value that is to be considered. Other than that, in all the other assets which may have been acquired before 1st April 2001, you will have to take up the fair market value. Only for the real estate, you check on that date whether the fair market value was more than the stamp duty value. If the answer is yes, then your cost will become the stamp duty value instead of FMV. Okay. Now, considering the question further, the previous owner has forfeited an advance of rupees 60,000 in a failed negotiation, students. In a failed negotiation, he has forfeited. What we are going to do for the son? Ignore. The SSC later incurred qualifying improvement of 2,35,000 and sold the property for 15 lakhs. So, sale consideration 15 lakhs. Cost of acquisition, students, 2,20,000, which is a fair mark, which is a stamp duty value as on 1st of April 2001. And then the cost of improvement that he did, 235. So therefore, total is this much, and the long-term capital gain, students, is 10,45,000. The long-term capital gain, students, is how much? 10,45,000. Is that point clear to all of you, students? And that exactly is the point. So therefore, just bear it in mind, this proposition, students, and this is what it is. Illustration 6, students, you will do for practice this particular thing. Again, a module-based question. So just ensure to just deal with that. Compulsory acquisition, students, just a quick revision on a particular point. I've discussed with this inherited and joint, this particular point also. Students, here, just one example of module, just wanted to discuss on that. This example I've picked up again from module. Students, you may be aware that father and then there are two sons. Okay, what will happen? And say father has created a will. Will is say 50-50% for two sons, isn't it? So when the property is sold, in that case, students, when the property is sold, in this situation, I will be responsible for my share only, isn't it? I would be responsible for my share only. So supposing the property or the stamp duty value is say 1.6 crore. My share becomes how much? 50%, 80 lakhs in this case. Supposing students, and to transfer that particular asset, it took total 4 lakh rupees. See, and only the entire building would be transferred. That you all are aware of it. And one transaction only. But I, being 50% co-owner of that particular property, I have a legal exclusive right to the extent of 50%. So my competition will be restricted only to the extent of that share which I am owning in that particular house property. So therefore, less, if the total amount is 4 lakhs of the expenditure, my share will be restricted to rupees 2 lakhs. Net consideration is 78 lakhs. Now, same way, cost would be cost to the previous owner, that is father. But for me now, it will be 50% of that cost. My share in that cost. So in that context, say for example, over here, let's have a look. See, grandfather bought a land in 1985. Fair market value as on 1st April 2001 is how much? 18 lakhs. Stamp duty value is how much? 20 lakh. In that case, stamp duty value is higher as compared to fair market value. What you are going to take? Whether you are going to take higher cost, whether the government would want to take you the higher cost? Answer is no. Always, I told you earlier also, and I'm repeating this again, you will find an attempt is made to reduce your cost or to enhance your selling price. That is generally an attempt. By reducing your cost or by enhancing your selling price, finally what they achieve? They achieve in increasing your capital gains. They achieve in increasing your capital gains. So therefore, if the fair market value is lower as compared to the stamp duty value as on 1st of April 2001, then whether you are still going to take up the stamp duty value as on 1st of April 2001 as your cost of acquisition? No. In that particular case, the fair market value is what will remain as the cost. Now that is for the entire property. My share is 50%. So my share in that FMB is 9 lakhs. So 9 lakhs is what I'm going to consider it. And accordingly, the long-term capital gains is what is calculated. I hope that every one of you are clear with this one, students. All of you. Fine, students. About the dealer, students, also same thing. The stock in trade, stamp duty value. For a dealer, for him it is PGBP. In PGBP also, should I be considering the selling price as the actual consideration received by the builder from the buyer, or it will be again on the basis of the stamp duty value? Same provision exists. Same provision exists, students, and therefore I have already discussed this one. This is just a recap that we have considered this particular part. So this thing I will be doing in a partnership assessment. This particular part, dissolution and reconstitution of a firm. This part, students, in a partnership assessment, in a taxation of various entities, in that primary, when we do partnership assessment, at that point of time, this thing I'm going to pull it up for all of you. This particular part, okay? So just provision I've given it over here, but we'll be putting up over there. Now before we enter into, now we come to the exemption particular part. The final segment of your CG particular thing. Students, therefore now we have a case of chargeability. We have a case of In the chargeability, we also see section 70. So chargeability is 67, 68, 69. And what is section 70, students? Transaction which is not considered as a taxable transfer. All that categories we have seen in that context. And after that, students, only then the competition begins. Because up to 70, we have to establish whether the charge is there or not. Up to 70, we have to establish what? Whether the chargeability is there or not. Only after 70, then we move to the competition. In the competition, we have seen the slum sale, a typical part. Capital gains competition, depreciable asset students competition, we know how it goes. Opening WDV, add additions, actual costs, less the money payable. And if the money payable is more than your opening and the actual cost, then you will have a capital gains. That is what we have seen. And then finally, the non-depreciable asset. What is the non-depreciable asset? Full value of consideration, less expense of transfer, net sale consideration, cost of acquisition, cost of improvement, capital gains. That is what it is. In the computation of total income, do you give indexation? In the computation of total income, do you give indexation? Again, students, even if it is 100 times I have to repeat, I will repeat it. Answer is no. So if the question is only about total income computation, you will not do any indexation, even though that option of indexation is available. But that option is at the time of calculating the tax liability. I give you one hint, students. How do you remember this? This is actually a conceptual point. Students, this part of an option, do you know where it is? It is not under the head capital gains. This option is there in section 197 subsection 3. In the Bear Act, students, you will, as a homework students, you will see from the Bear Act. 197 subsection 3, you will find this option. And what is section 197, by the way? The special rate of tax for a long-term capital gains. The special rate of tax for a long-term capital gains. In subsection 3 of that section 197, you get this particular option. So if you are getting this particular option in a tax rate, then tell me, are you going to use this option in the computation of total income? If you are getting this option in a tax rate, which is the option? With indexation, you can take 20%. So tell me, if you are getting this option in a tax rate provision, will you use it in your computation? No. You have to restrict yourself. The computation of capital gains is from 67 to section 92. That's it. 67 to 92 is your computation of capital gains. That is it. So in such particular case, students, you will not go. You will capital computation has to be done in that method. And in that computation, you don't have any concept of indexation. Now, so therefore, indexation is gone primarily, and accordingly, in total income question, you will only write full value of consideration less COA. That will give you LTCG. Okay? Only when the tax liability has to be calculated and the conditions laid in section 197 subsection 3 is satisfied, that you will put a working note on that. Is that point clear now to all of you? How to see this one? And please remember this particular point, because something of this also will come in the non-resident taxation. At that point of time, I'm going to ask you the same question. And let me see how many of you remember. Remember not in the terms of this, remember in terms of the logic. I require students reasons. Reasons, the most statutory reasons. And you have to develop that skill, students. This is the art. This is the real aim that the CA students should have. To have an ability not to give a final answer, just to give a final answer, but to have an ability to reason their final answer. Why they have come to this. And that needs to be provided in a very analytical and in a very analytical interpretation way. That this is the reason why we don't use it in the computation of total income. I hope that every one of you are now clear with this one, students. All of you.
No, sir, I didn't get it.
Hmm?
Sir, I didn't get it. Like, why 197.3 is not used? Like, I'm not clear with the logic.
Your voice is very less. Rana. Can you just speak?
Sir, am I audible now?
Yeah, yeah, now it is audible.
I said that I am not clear with this concept. Whatever you explain, why in the total income it's not taken.
In the total income, see, last session, if you see, remember in the last session, remember that particular thing, we were discussing what would be the legislature intention. That why in the total income, they want to give a effect which is without indexation. At that point of time, if you all only have replied that the reason could be that there is an attempt to make the surcharge. The reason is that if you go in the total income side, in that total income particular part, if you see on the total income particular thing, the total income says without indexation. What do you mean by without indexation? Full value of consideration is say 100, say cost is say 10. Okay, do it in that way, 90 lakhs, that's it, 90. That is what it is. But when you have to see the tax liability calculation and the condition of that individual HUF and the property has acquired, real estate property has been acquired before 2024, those conditions are satisfied, then you make the alternative. And what is the alternative? Alternative is that without indexation 90 at the rate of 12.5%. Can you tell me the amount in this case? How much is the amount? 12.5%. So 12.5% of 90 would be
11.25.
11.25, isn't it? 11.25. So in this particular context, see if you see over here, so this is 11.25. And this will be compared with what? With this other one. Other one is what? In this case, so it is 100, full value of consideration is 100, and less ICOA, index cost of acquisition, in this case. And say, for example, index cost of acquisition by taking the CI of the year of transfer, that is the current year, and the CI of the year, whichever has been there. So, say, for example, my cost comes to, say, 40. Now, this becomes how much? 60. And then my rate under 197.3 gives me an option of 20% because I've taken the indexation as an option. This becomes 12. Now, in this particular case, when I see what? See that, okay, without option, without this thing, it is to 11.5. With indexation and at 20% rate, it is 12. So, which is more beneficial in this case? I will go with this one, 11.25. And then in that case, this tallies what? In this case, your competition is at 90. Total income competition was at 90 in the total income, and your tax liability was also at 90 at 12.5%, which is 11.25. Okay, but let me in fact change this number further and I put this as 50. So 100 minus index cost of acquisition, which is 50. So your this one becomes how much? 50. Now your rate 20% on 50 becomes 10. Now suddenly what happens? This is more beneficial. So now what is the position? The position is that in your total income computation, primarily it is 90, which is the value which is appearing. But because of 197.3 option, which is a tax rate provision, in tax liability computation, therefore, you find that with indexation option which is given to me in 197.3 and at 20% rate on that LTCG, indexed LTCG, I get 10 as my liability. So in such particular case, I will go with this 10 as my liability. So my liability primarily is 10 and my tax liability particular calculation. So 197.3 is only giving you an option, and that option is only to be considered at the time of calculating your tax liability. That is a simple particular point that you should always remember it. 197.3 is only giving you an option, and that option has to be considered only in the tax liability computation. When you're doing the computation of your total income, in that you will have no indexation effect. It is indexation is gone. Just think of that way that indexation concept is gone when it is a total income concept. Only when you calculate your tax liability, 197.3 creates an option that old provision will be still be applicable. You decide which is more beneficial to you, whether without indexation 12.5% is that more beneficial, or with indexation 20% that is beneficial to you. But that option is when you do your tax liability computation.
Yes, sir, got it.
Fine. So
Yes,
just
yes. Unindexed portion only will be the part of total income.
total income. Keep this particular thing firmly in the very first particular page that you will do. See, these are certain gray areas. That's what I was the other day when we were discussing that I was discussing what to revise. Now, just I can tell you, Radha, like if I were you in this case, if I were you, I will keep this in my revision particular slot. Means, as I told you, time is very less for everyone. So, and everyone has a very unique thing to be revised. Not that everyone has got the same particular footing. For me, this may be a strength. For someone else, that may be a strength. It could be anything, primarily, in this context. So, it depends upon student to students in this regard. So, the moment I know that, and not only from that, in the topic itself, in this case, for some students there could be this area, from some students this could be the other area. So area to area in that scenario. So it's everything which is student specific. And that's the reason why I strongly recommended for every students that whenever you revise, you should always bear it in mind, only revise where your shoes are pinching. That area is something students you need to keep a grip till the study leave. In fact, when you before the study leave, because this is an important particular thing, since it's a thing which I can just share with you, always ensure on one thing, students. Kanaya, other day you were also saying that sir, the time is very less for us for revision because we have the articleship also and other pressures are also there. So this is how we use the time till my study leave. Obviously, time is premium. I will ensure to revise that portion in this case where I'm making a frequent mistakes or where my shoes are pinching. This is the area I'm going to carve out. Rest of the things is settled in my mind in a logical flow. I'm very much clear on that particular part. But where I'm making a repeated error, that is a thing which I will ensure to not forget it. And this is what I need to be sorted before I hit my study leave. And this is for all the subjects, which I can tell you from the experience. And once you are study leave, you are on your own. You are a sorted student as far as all the subjects are concerned. And then you can go for a kill at that point of time. So this is students, the time management becomes very critical task. And this is the point that is something that you should always bear it in mind. Fine, students? Do this one because I'm telling you, this is what ultimately it will boil down to. So at the end of the day, it will boil down to only this: how you have used your this particular period in this context, and this is how you should always bear it in mind. So things that you are already sorted, you don't have to keep on revising it because if you are keeping on revising that, you are just merely duplicating the efforts. But the things where you think that you are making some repetitive error, that's the area you need to keep your entire focus on and keep in your whatever is a limited time that you get in your revision or maybe sometime in your office also, use that particular time to the best of their ability. So at the end of the day, everyone has that limited time only. How everyone use that time ultimately is the game. CA final teaches you that particular part, students. Okay. All of you just take a 10 minutes break. Today, will it be fine if you take only 5 minutes break, students?
Sure, sir.
Only 5 minutes break. Because then we are doing the exemption because today 9 o'clock only I have to cut off. So that's the reason why. Okay?
Okay, sir.
Okay, sir.
Okay, okay. Thank you. कन्हैया जी 5 मिनट का ब्रेक ले रहे हैं. सॉरी संकेत जी.
Okay, sir. Break starts.
हाँ 5 मिनट्स का ब्रेक. So students, let's start.
Yes, sir.
Now students, we'll see on the next particular part, which is on the exemptions and the rollover. So students, as I have told you, we have a chargeability, and the chargeability extends till 67, 68, 60, 67, 68, 69 chargeability, and then section 70 also. Transaction which is not considered as a taxable transfer. So that becomes section number 7070. And then thereafter, students, the next particular part is on the computational side, which we have discussed. Slum sale, students, just be careful. Slum sale is quite an important particular question because independently, slum sale based questions are being targeted. We discussed full value of consideration is higher than the fair market value, full value of consideration, fair market value 1 and fair market value 2. Then reduced with the cost of acquisition, which is the net worth. And then that time I gave you the logic behind that cost of acquisition net worth versus the fair market value net worth in the full value of consideration. That logic we discussed. And after the computation, students, the next particular part is about the exemption. Now, students, the next session we are going to solve the questions primarily in this context. Because as I told you, even the IFO's particular part, I have considered it in this case. So I will be using the next session for the solving of the question which is coming towards this one. And that's the reason why I will request to all of you, if it is possible, to just ensure to revise whatever you have done so that we will be in a position to solve the comprehensively the questions which we have discussed so far. Okay. Along with the exemptions now. Because see, illustration solving is one thing. When we solve illustrations and all, you may get illustration. It's not that we are discarding anything. At final C level, you just can't discard anything. But illustration level may be like an adjustment kind of a thing could be there. But if at all we can expect it something like a case study or an integrated case study, there could be a very comprehensive question that has been targeted. So before that, let's start with the exemption start now. Students, there is an exemption which is one important exemption, students, you will find, which was old section number 10, which was there, 1037. Now that exemption is now in the new act, it is in schedule number 3, table serial number 18. That is where now this particular exemption has been put up. Schedule number 3, table serial number 18. Now what that particular exemption is all about, should just have a look. Here, if you see the eligible SSE in this context is the individual or HUF. The eligible SSE happens to be individual HUF. That individual or HUF SSE has transferred an agricultural land. But be careful, student, this agricultural land that has been transferred is in urban area. Because as you may be aware, in the rural areas, if you are transferring an agricultural land in the rural areas, it is not a taxable, it is not a capital asset. So the question of capital gains or taxability will not arise. So therefore, if you are talking about an exemption, first, if you should just as a concept, if you talk about an exemption, there has to be a charge. So far as a rural agricultural land is concerned, it is outside the charge itself. Why it is outside the charge? Because in the definition of capital asset, rural agricultural land is not defined as a capital asset. It is excluded. And therefore, there is no charge of transfer of rural agricultural land. Under this head, there is no charge. And if there is no charge, the question of its exemption also will not arise. Isn't it? So, if we are talking about exemption on the agricultural land transfer, then there has to be a charge. And that charge can happen only if that agricultural land is a urban agricultural land. So, if an urban agricultural land has been transferred, then only then you will calculate the capital gains, only then the chargeability will be attracted. And once you calculated the capital gains, that the exemption will be applied. The exemption, students, is in that schedule number 3. See that particular thing, serial number, just forget it. Schedule number 3 should suffice. If at all you can remember that much also is sufficient. Or else you can just simply say exemption is available in this particular LTCG. So what is the asset that you have transferred? It is the urban agricultural land. Now be careful, students. It should be the condition now. The condition of exemption is that this agricultural land should be in use, students. What is the condition? This agricultural land should be in used for agricultural purpose, not that used for any purpose. So the land should be used for the agricultural purpose during 2 years immediately preceding the transfer by the individual, or either he is using it for agricultural purpose or his parents or the HUF, as the case may be in this case. And now, students, the nature of transfer for which you will get the exemption. Transfer definition has got various variety like sale, exchange, relinquishment, extinguishment. So what is the nature of transfer for the purpose of exemption? They say that this transfer should be in the nature of compulsory acquisition by law, which means that the government should have acquired your urban agricultural land. It's a compulsory acquisition by law, and only then we will be giving you this exemption. We will be giving you this exemption. And that exactly the point it is in this context. Now, in any other way, students may be thinking that, sir, if I only sell that urban agricultural land, will I be getting this exemption? No. The transfer that is contemplated for exemption purpose under this Schedule 3, serial number 18, is the transfer is through compulsory acquisition by law. So if there is any other mode of transfer that has taken place, in that particular case, it is not a compulsory acquisition by law. If it is not through a compulsory acquisition by law, but it is through a sale or through exchange or through any other mode, then this benefit of exemption, students, is not applicable. Is not applicable. Okay. Now there is one interesting judgment, students, of the Supreme Court. These are all module-based judgment I have already covered over here. Balakrishnan versus Union of India 2017 Supreme Court. Now what happened, students, is that the assessee's property was compulsorily acquired. Now, because that the assessee's property was compulsorily acquired by the government through the law, but the assessee entered into a negotiation with the government about how much compensation amount you are going to pay to me. For that, series of rounds of discussion happened between the assessee and the government. And after that, they came to a particular amicable amount which was agreeable to both the parties, government and the assessee. Accordingly, assessee took that amount and he claimed the exemption. But the income tax officer or the assessing officer was of the opinion that because the assessee got the compensation through what? Through the negotiation. Through the negotiation, he could get this much of the amount of what? Of the compensation, because he was initially the government gave him 100, but then he entered into negotiation and finally he ended up getting 160. So therefore, because that compulsory acquisition, the assessee ended up doing negotiating this particular amount. Therefore, this is like a sale on the part of the assessee because he negotiated the higher amount. And then both of them arrived at what? Arrived at the particular amount which was acceptable to both the parties. And therefore, the AO was of the opinion that this 160 amount would be considered as what? Would be considered as what, students? Indeed, as a sale amount. The Supreme Court said that it is not a case of a voluntary sale. The asset was acquired through a law, and through the law, the acquisition happened. And this was compulsory because the law was attached. And then only the acquisition took place. The fact that assessee negotiated his compensation amount does not change the character of transaction. And what is the character of transaction, students? This acquisition happened because of a process of a law. And through the process of the law, that the acquisition took place. And hence it is a compulsory acquisition of property. It is not a case of a voluntary sale. And therefore, is the exemption available? Answer is yes. Just because the assessee negotiated to a higher amount, that does not change the character of transfer. That does not change the character of transfer is the judgment, students, of that Supreme Court. Now, students, again, the illustration has been given over here. Students, individual cost is say 6 lakhs. Compulsory acquisition happened in this case. Compensation amount, students, was 12 lakhs. it is qualifying for agricultural use. So whether the assessee was using it before the compulsory acquisition, either himself or his parents or the HUF, yes. Accordingly, whether the capital gains of 6 lakhs, whether the computed capital gains of 6 lakhs, will it be exempt? Answer is yes. The next illustration, students, same land sold voluntary to a friend. Now you tell me, is it a compulsory acquisition by law? No. And because it is not a compulsory acquisition by law, therefore no exemption would be available. Come to the next illustration number 17. Compulsory acquisition but qualifying agricultural use condition fail, meaning thereby, although it was an urban agricultural land, but it was not used for agricultural purpose. It was not used for agricultural purpose, and therefore, students, answer is that no exemption would be available because it was not used for it. And land, last case, students, land was belonging to a company. Whether the exemption will it be available? Again, the answer has to be no. So this was one of the important exemption. Just keep in mind because these are the fix that could be there in the question in the exam. Now we come to this other exemption, students, which is the 54 series exemption. Remember that 54 series exemption, your favorite exemptions and all. Now this 54 exemption, students, in the new law, it is covered in section 82. That 54 which was there earlier in the old law, it is in the new law, it is covered in the section 82. Let's have a look, students, over here. What do we get? I think you may be aware of it, but students, these particular sections are important for case laws also. In the ICAI module also, students, if you see, there are a lot of case laws which are being attached. So these exemption particular part, students, important is the case law particular factor in this context. So just keep an eye on the case law particular part. So obviously we will go through everything on this particular part, but the case law is what we will also deliberate, main importantly. So I have covered the case laws in this notes also. I hope that this notes is already there in your portal. If I am not mistaken, in your LVC class portal, it is there. You would have taken it already. Perfect. Now, eligible SSC students. Who is eligible SSC? Individual or HUF? What is the original asset which has been transferred? It is a long-term residential house. It is what? Long-term residential house. How it becomes long-term? Period of holding should be more than 24 months. In this case, if the period of holding is for more than 24 months, it is a long-term residential house. Now, that residential house is building or land appurtenant thereto. Income from which is chargeable under the head income from house property. What about the commercial house property, students? Whether a commercial house property which has been transferred, whether you can get section 82 exemption in this case? Answer is no. Restricted only to when the transfer is of a long-term residential house, then and only then the exemption of section 82 will be applicable. Okay, just keep this point in mind because something else is going to come soon. What is a new asset that you should acquire if you want to claim the exemption on the long-term capital gains on the transfer of residential house being a long-term capital asset? What is that new asset that you should acquire? One residential house in India. One residential house in India, students, is what you require. In India, can you see that one, students? In India. I gave you this example earlier, if I am not, now I'm not recollecting, but I think I have already spoken with you. There was this SSE, she actually transferred one flat in Mumbai and then she acquired a new flat in London, in UK, United Kingdom. Therefore, the question that came up was whether she would be eligible for the exemption of long-term capital gains. Under the old law, before the amendment under the old law, in India was not written. They have only mentioned new asset that should be acquired should be one residential house. That's it. Where you have acquired it, that was not mentioned. And because you have not mentioned that, therefore, exemption provision, students, be careful, you may be aware of it. Exemption provision, students, has to be interpreted in a liberal manner. The interpretation should be more liberal. Unless we have got a very specific condition which disallows the benefit, we will interpret exemption provisions in a liberal manner. And therefore, the court held that because in India was not mentioned, therefore, wherever the assessee may have acquired the new residential house, the benefit of the exemption would be available. The benefit of the exemption would be available. Now, to overrule that judgment, they made the amendment. And what is the amendment? Now we require what? That the new asset or the new residential house that you should acquire should be very much in India. Should be where? In India, students. I hope that all of you are clear with this one. Fine, students. Now, I hope that, or I assume that you may be aware of this amendment. This is an old amendment in the old law. Maybe or may not, I don't know. But let's do this one. If long-term capital gains does not exceed 2 crores, students, if the long-term capital gains does not exceed 2 crores, then in that situation, students, if the long-term capital gains does not exceed 2 crores, the assessee may opt for 2 residential house in India. This 2 house option can be exercised only once in a lifetime. Now, students, many a time you would have known, like for example, there is one big bungalow which is there. Okay, big bungalow which has been there. Now, this big bungalow, students, has been sold. This big bungalow has been sold, students. Okay, has been sold for 10 crores. And against that, the cost of acquisition was, say, rupees, in this case, 6 crores. 4 crores is the long-term capital gains. Okay. Now, intention of the many times you would know that I want to sell one big particular thing, and because there are 2 children, I want to buy for them 2 flats. Many times this happens in this case, and therefore, if I only acquire one, if supposing the exemption is only applicable one-on-one, that one sell one, buy one, then I'm selling an elephant and I'm buying a small particular, a baby elephant. A big elephant to a baby elephant is what I'm buying. 2 baby elephants. Now, obviously, the capital gains here is 4 crores. And if you say that you will be allowed the exemption only in respect of one house, then assessee will say that one house, I'm not supposed to now again buy a bungalow. So what the assessee will, the general need, this was a trend which was going on. Sell a big house and buy 2 houses or 2 or more houses. So the government recognizing the trend, what they did is that all these big houses which were being sold, for that they gave this particular flexibility. And what is the flexibility, students? Exactly. The flexibility, students, that was being given in this particular context was that you can now buy, students. You can now buy. Yeah. So you can now buy, students, that particular 2 flat option has been given. So 2 flats you can buy in this context. So now you can buy 2 flats, and accordingly, after reducing that, whatever is the long-term capital gains, you will be eligible. Whatever is that balance long-term capital gains, this is a 82 exemption. After that, say for example, 2 flats, I have purchased, or whatever is the amount. I'll show you through the numbers in the this thing. Whatever is after that 2 flats, the long-term capital gains, whatever is left, that is taxable. But please understand what they have told you is that this option is only once in a lifetime. What does it once in a lifetime means? Whether 82 is available once in a lifetime or this 2 crores, the 2 house option is available once in a lifetime. What is once in a lifetime? 82 is once in a lifetime or 2 house option is once in a lifetime?
2 hours option is
Two
once in a
house
lifetime.
option. Students, 2 house option. Because understand, no, this kind of issues you may know, bungalows are there and that gets sold. And now, second thing, I don't want to buy another bungalow. I want to buy some flats, but those would be multiple flats because of the family descendant who are there. For them, I am buying the flats, and for that, I'm selling the bungalow. So therefore, this kind of a pressing need will actually the government recognize if you have got bungalow, if you are only that bungalow selling and getting this huge capital gains of more than 2 crores and then buying two flats, this option only once, only to give you an exit from your old, this big particular flats for which you are getting a huge capital gains of more than 2 crores. Because the condition is there, students. Your capital gain should be more than rupees 2 crores. So therefore, only then you will enter into this particular context. Okay. So this option, students, is only one thing. Next year, say you want to sell one more flat, against which you want to buy another flat. Those things you can keep doing it. No harm on that. That is allowed. But this particular thing, students, you have to be careful.
But
Now
sir,
let's
here
come.
you have
Yeah.
written that LTCG does not exceed 2 crores, sir. You
Oh,
said that
sorry,
if
sorry,
it is
sorry, sorry, sorry. Yeah, yeah. At LTCG, I'm just goofed up here in terms of the calculation part. Just excuse me from this one. We have to just change this particular figure more. This particular part. Just a second. Let me change this number, friends. Just a second. So, yes, Radha, you're correct. 8.5 CR. I'm just reducing this to 8.5 CR. So now with that particular thing. So now in this case, this option 1.5 CR. So whether two flats can be used against one single flat sold, two flats purchase or two flats construction, can that be used against one flat sold? Answer is yes. Two flats purchase or construction can be used against one particular residential house sold. Only condition is that the amount of the LTCG should not exceed more than rupees 2 crores. Okay, so just bear this particular point in mind, students. Now, in this particular context, students, there is one important particular, there are case laws after case law, students, in this case, and many case laws have been targeted in the examination in past. So you are expected to know this case law. One is that Karnataka High Court judgment in Ananda Basappa, and that was also being upheld in Sayyid Ali's case. Just have a look, students, first. This was also, be careful, friends. Just read this one. I don't want to tell the answer straight away to you. I just want you, time limit. Can you see this time limit? You read this time limit, and I will ask you a question, and then let me see how many of you pick up this particular point. Just read this time limit. The last particular row. Read it, students? Perfect. So now in that context, let me get you a question. So students, here was the transfer that took place. This was the date of transfer. Okay. Now, as you know, students, that obviously many a times, see, I have got only one house, say for example. In that case, if I've got only one house, obviously before I sell, I need a roof in my on my head. So there are people who does that pre-acquisition happens earlier. So that at the time when they sell the existing house, they already have a roof on their head. This is normal practice. So therefore, you see the date which is before also, which has been there. So accordingly, what happened was that there was an SSC who started the construction activity. Okay. And he constructed the entire house property just before the transfer, 6 months before the transfer. Just 6 months before the transfer, he finally constructed it. He started residing it. And then he transferred the house property. Then he transferred the house property. And then in that situation, students, the capital gains was calculated. On this transfer, the capital gains was calculated, and he wanted to claim the exemption under section 82 of the house property that he got constructed. House property that he got constructed. He wanted to claim that exemption, students, in this case. So whether the exemption will it be available in this case? Just 6 months before, huh? Students, 6 months before. Whether the exemption will it be available in this case or not is the query to all of you students.
Sir,
No,
Yes,
sir,
what?
it
yes.
won't be available.
Okay,
Yes,
you
sir.
continue.
Sir, actually, we have condition like before within 1 year before transfer for only purchase. For construction, it is after transfer. So for construction, it won't. We cannot take that exemption.
Yes, Yogendra. Very true. That is the case in this case. So if you see for the purchase particular part students, this particular option of before the transfer, this option is available only in the case of purchase, and that too within 1 year before transfer. So far as the construction is concerned, it has to be within 3 years. That is the game in this context. Some may say that sir, it's quite unjust, right? Construction, but as I told you, they see the general trend, students. What is the general trend? When they give a time limits and all, when they create this kind of a limits, they see what is happening in the economy. That's how these kind of things get framed up. It not happens in out of the blue. Somebody may be constructing also before it, but the government could not have seen those things because those are very few transactions that may have happened in the country. But this, before transfer, purchase of the another flat is a very frequent particular thing that happens. And that is what they have kept it. Because in one of the case, what happened was the SSC constructed, this is a case law I'm talking about it, the SSC constructed it just before the transfer happened. And then unfortunately, the government went by the letter of law. They say that in the law itself is not written, how can I give you that particular exemption? What is written is only about the purchase, and that too before the house has been transferred, and that too within 1 year. That's it. So construction student doesn't have that particular leverage. So purchase 1 year before or 2 years after, within that period. But construction is only 3 years after, within that period. Only you need to do that. I hope that this point is well taken by all of you students. Old case law, but it is a case law based particular example which I have given you. Now, students, how much is exempt over here? Now, students, there is an upper limit that has been given to you for the very first time. Are you aware of this upper limit which is there in 82 in this context? So over here, let's see the cost. Here, if the cost of the new asset is at least the LTCG, the entire LTCG is sheltered. Sheltered means exempt. In this case, meaning thereby the capital gains or the net amount invested, whichever is lower. Simple word, if I have to just use the word, students, you can write also 82. What is the exemption, students? The capital gains. You just write in your notebook, students. 82 exemption is LTCG or net sale consideration invested in the new asset, new house, whichever is lower. LTCG or net sale consideration invested in the new house, whichever is lower. Okay. So that is what it is. That is what it is, students. Now, say for example, students, your LTCG. Now, just read the provision and you have to answer me this. You only have to answer it, students. My LTCG is say 15 crores. And my new house, new asset invested, students, is say 12 crores. Option 1, 12 crores. Option 2, it is. Yeah, let's take it one by one. LTCG of the house is say 15 crores. In the new house invested, it is 12 CR.
Sir,
Sir,
12
can you
CR.
confirm the new house invested is only single house, right, sir?
Yeah, single house. This is a single house.
Yeah. So we can take exemption up to 10 crores.
So over here, students, now we have got a cap. Be careful. The cap has been given. So this, students, now the new, when you have written the students, that particular long-term capital gains, or what you have written, students, amount invested in the new house, whichever is lower. So can you now refine after this the same sentence that you've written in your notebook? What are you going to write? Long-term capital gains or amount invested in the new house up to rupees 10 crores. Now this is the case. Write the provision again so that you will never forget it. What is that? LTCG or what? Amount invested in the new house up to rupees 10 crores. Whichever is lower is what will be the exemption. This is how you are going to speak, students, now going forward. This is what is a simplified entire thing which I have given it to you. Is that point, students, clear to all of you? Have you written the sentence in your notebook?
Yes,
LTCG
sir.
or amount invested in the new house up to rupees 10 CR, whichever is lower. So therefore, this 12 CR would be measured up till 10 CR. So therefore, any amount that you now invest in the new house, if it goes beyond 10 CR, that limit would be restricted to 10 CR. So LTCG or this one. So therefore, exemption would be restricted to 10 CR. So how much is the taxable LTCG? 5 CR. This is the balance which is taxable. I just want you to focus on this particular part, students, carefully. Just keep in mind this particular part in mind in this regard. Rest of the things primarily are those like simplest thing which primarily will not be deliberated. This was CAGS. Remember CAGS scheme, capital gains account scheme. You may be aware of it. The fact that 2 years forward is given and 3 years forward, 2 years forward is given for purchase, 3 years forward has been given for construction. A doubt may arise in the mind that, sir, that 2 years forward, obviously return due date has already come. You have transferred in tax year 26-27. The return due date has come in July 27. You would purchase up to 2 years from the date of transfer, or within 3 years you can construct. But how does the assessing officer knows your intention that you would be purchasing it or you will be constructing it, and therefore you are claiming an exemption of 82? For that intention to be evidenced, you need to deposit your amount in the CGAS amount scheme. By depositing it, primarily you will accordingly be eligible for exemption under section 82. So deposit the amount, students. Generally, people deposit only up to long-term capital gains because that much of the amount only is required to be deposited. Because what is the exemption? Exemption is LTCG or amount invested in the new asset, whichever is lower. New asset up to 10 CR. LTCG or amount invested in the new asset. So amount invested in the new asset, I am going to do it in the future. Isn't it? At least that LTCG part, to get a full exemption, at least I need to deposit the money in the LTCG particular part. So if the LTCG I know, I may have earned through the net sale consideration of my old house which I've sold. Net sale consideration of old house which I've sold is say 2 crores. Okay, and then the LTCG, students, is say 50 lakhs. I would want to buy a new house, but am I supposed to deposit entire 2 crores in the capital gain account scheme? No, you just will deposit only how much you want to exempt it. You want an exemption of 50 lakhs. You may invest more or you may invest less. That is a future thing. But if you want to claim an exemption straight away, you will have to do what, should you will have to, students, in at least deposit 50 lakhs in the CGS scheme. By depositing 50 lakhs in CGS scheme, what will do? Now you will say less exempt. You will say what, students? Less exempt. Exempt for what? Deposit in CGS scheme. So from this LTCG, if I have Full 50 lakhs if I'm depositing it, full 50 lakhs if I'm getting the exemption. Because that is an intention which you are showing to the government that at least 50 lakhs I'm going to invest in the new house. That is with the intention. Huh? By depositing 50 lakhs, what you are telling to the government? At least 50 lakhs of the amount I am going to invest in the this scheme, in my new asset. So that is the exemption that you will claim. Now, students, what I'm going to I'm leaving up you with this particular thing, a homework which I want all of you to be ready. Case law students, in the next session we will be discussing it, but I just want all of you to read two sections and be ready. They are important one because they are very important in the examination final C level. Section 85, this section 85, this section 85, and one more section. One more section, students, and that is 84. Just a second. Huh? 86, 86. 85 and 86, students. Two sections, just ensure to read and be ready in the next class. And we will be after that, students, we are going to solve the questions, integrated questions on this chapter. Okay. So what are the questions which have been there? We will be doing it, and then towards the end of the session of the next class, we'll start with the IFOs towards the end. So next session, I'm reserving it for the question particular part, students, of integrated question we are going to solve from this particular chapter. Be ready. Just help me out by reading these two sections, which is the two, 85 and 86. And one more point, any of the areas that probably the things that has been done earlier, should just revise if it is possible. At least that area which you would have been felt otherwise a bit uncomfortable at some point of time. So that through the practicals, we will try to iron out those discomfort which would have existed earlier. Okay. So let's do that, students, and be ready for the next particular class.
Yes, sir. Sir, I have a query. May I?
Okay, quickly you can definitely.
Just quickly, 71ZE, the conversion of a company into LLP. What is the lock-in period when it is being when the capital is whatever the assets were there, now which were in
5 years,
transferring
5 years, 5 years.
5 years lock-in?
5 years.
Okay,
But
sir.
I'll still confirm. Confirm from the Bear Act one. So I have not got the Bear Act right now, but I'll still confirm. But 5 years it is. To the
And
best
the
my
last
memory serves, it is 5 years.
and the last one with regards to CGAS, sir, entire capital gains is necessary to to invest. Otherwise, we will not get even if
Yeah.
parts.
If suppose 40 lakhs only you invested, so
Correct.
LTCG calculation is 50 and you are only
Correct.
investing 40, which means you are showing an intention to the government that I'm going to buy a property which is of 40 lakhs. So therefore, long-term capital gains or amount, so your deposit in the CGS technically tells your intention to the government as to how much of the amount that you are going to invest. So
Okay.
generally, as a practically, what we always tell, at least deposit how much to the extent of whatever you have got your LTCG, so that your entire LTCG would be exempt. But if there is any shortfall, like in your example, it is 40 lakhs only what he has invested, then for LTCG is 50, 40 is what has been deposited, so the balance 10 will become taxable.
Okay, sir. Got it. Thank you.
Okay, okay. So see you then,
Sir,
students. Yeah, yeah. Say.
yeah, so one confirmation required. Sir, the associate has started construction before transfer of asset, like before
Okay,
transfer of house property,
that is allowed.
but completed after transfer of house property.
But within 3 years.
Yeah, yeah. Example for 1 year. After filing 1 year, but he already invested some of amount. Some of the amount has been already invested in while construction, and some of amount has been deposited in CGAS. So he can claim
He
the
can
sum
claim,
of
definitely.
investment
Yes, yes,
amount is
Yogendra.
deposited
He
amount.
can start before, not an issue, but he should not complete before.
Complete before,
Completion
yes.
has to be within 3 years from the date of transfer.
Yeah, sir.
So he
And
can
also,
start.
sir, yeah, and one more thing, sir, this is regarding previous class discussion regarding of LLP conversion. So you said that tax benefit will be available only if we transfer like uh, after 3 years of incorporation.
That should
Sir,
be minimum number of years old entity.
yeah, but actually, sir, when I referred one more to BERAC, it said that within last three preceding years, it should not exceed so and so
No,
amount.
no, the 3 years,
Like,
what we have
right.
said was is that in the last 3 years period, the threshold should not have increased in any of
Yes,
the
sir.
period.
So, what is my concern means, as per Companies Act, it is saying that after 1 year you can convert.
That you can do it.
So, if we refer to both, if we combine both the Companies Act and Income Tax Act, even after 1 year we can convert
You
with
can
the
convert.
tax benefits, because before 1 year, like before this 1 year, that means which last 2 years, where the LLP is sorry, company is not yet incorporated, which means the threshold limit will not be crossed, right, sir?
Yeah, true.
So I think that
In
companies should
Companies Act,
not
Yogindra, it
need
is
to be
allowed.
old of 3 years.
Yeah, in Companies Act, it is allowed. Primarily, that's true. But for income tax benefit, you need to at least be that much of the year that should have passed so
Sir,
that the limit can be tested.
so let me give an example, sir. If the company has been incorporated on April 2024,
Okay.
April 2024, and as per Companies Act, we can like convert into LLP after after submission of that AOC 4 and all. And also, sir, if we consider the Income Tax Act, so here for 24-25 we didn't cross the threshold limit, and before that, like means 23-24 and 22-23 also, the company doesn't exist, so the threshold limit also zero, so we can claim
No,
that such exemption, right, sir?
no, that is you have to not take that zero therein. They want to see whether, like, see, 1 year. If you see 1 year, everyone would have been this thing. So in that case, they would want that this conversion benefit which we are giving is generally to help the SME, because see, in income tax law only we have got the limit, na? The turnover limit, that fixed asset limit. In Companies Act, we don't have such limits. In this case, the
Yes, sir.
turnover limit and the fixed asset limit, the kind of limit. Here, the income tax law is to facilitate, and therefore to being facilitation in nature, therefore generally one who is struggling, that we are facilitating. If you are not struggling at all, therefore we are not going to give you this particular benefit. So the benefit is mainly for facilitation of these companies which are otherwise struggling in this context, and that is the reason why this private to the LLP sort of a scenario which we exist in this context, when they have given a 3 years threshold period, which is before this one, 3 years we are giving, and test any of the year if you exceed that threshold, which implies that the government want to see, are you have that capacity of becoming a big company, and the moment you have the capacity of becoming a big company, we will not be giving you this particular benefit. Income tax, we are giving you this benefit of an exemptions and all. These exemptions cannot be made available to all the LLPs in this context. Therefore, this exemption is, if supposing the 3 years period in 1 year would have crossed it, in this case, this means that you have got that potential of a very big company. So that's the reason why they have meant in that particular way that 3 years period is what we require as a lock-in, so that we are in a position to test that condition that you are a small entity which want to now get converted into LLP because of that sort of a compliance burden that you are in fact having in that particular section 47, in that section 70.
Okay, sir.
Okay, okay. So I'll see you then students in the next session now. All of you. Okay, just revise students, just be there so that next session we could solve the questions at that point of time. Sure. Okay, Radha, take care. Thank you. God bless to you as well. Bye bye. Take care. Take care.
Okay, sir. Good night.
Good night. Good night. Good night. Kanaya, Radha, all of you. All of you. Yogendra, good night. हाँ बंद कर दीजिए. Thank you.
Recording stopped.